you give me your feedback too. You see what I'm saying?
This was for real.
Yeah, like bro, we literally about to learn this shit. Like I already know you already know, but like even for future stuff, I got a couple stuff you say you don't really look at the time and stuff. I got a
Yeah,
few
yeah,
videos that I feel like I kind of have an understanding on that. So I'll give you that too, you know what I'm saying?
yeah.
Um, because bro, I don't know, but I just been doing some research, and the fact of the matter is, it's just grind.
Mm-hmm.
Like if you put in the grind, like how we looking at those fair value gaps, brother?
Yeah,
You think if that fair value gap come on show itself again, we not gonna capitalize on that?
definitely, bro.
You
Definitely.
you see what I'm saying, bro? I've been looking at it all weekend. I'm like, if they ever give this setup again, let me
Yeah, man.
recognize it from the bottom. But
Yeah, man. Yeah, yeah, and I'm food, man.
yeah, bro. But you understand, that's only in my mind now, cause I've watched it. I was studying it. I was back playing it. I'm going back in my chart, back testing. You know what I'm saying?
Yeah.
So yeah, bro. I think we got to get on a nice schedule, couple times a week, something. And I don't know how we're gonna do it, but couple times. I feel like that John will help us.
Because you know my schedule going on. Me choose the evening shifts them I want to replace. Specifically because of trading.
Yeah.
So, I work from like 12 until 9. On Sunday, it's supposed to be like 11 until 7. So, I'm always free in the morning.
Yo, let's get it. Let's get it. Let's get it.
Talk in the morning session.
Yeah, man, that of a forex. So like GBP, USD, and like all of them what call it? Tier them. So me used to
Yeah.
trade London session, finish by about 3, 4 o'clock, catch back and up, wake up back by 7, 8 o'clock, we catch back London session. But we not
Yo.
really full time again. Yeah,
Yo. Yo, bro, you was on the grind.
yeah.
That's
So
some serious grind time, brother.
yeah. But the schedule kind of change up since me start work. So
Yeah.
like me that work and sleep, I kill me man. And then now like when me reach
Yeah.
in, when especially like in the summer month, them you know like from the touch February, March, the place get hot. So like me take a while to drop asleep. So when me drop asleep, when me normally can go to my bed by like 9, 10 o'clock. After 9, 10 o'clock, so you
Yeah.
know, it kind of set away. So enough time you drop asleep until 11 o'clock or something, yeah, twist and turn. So if you have to go wake up 1, 2 o'clock to London session, man, you mash up, man. So
Right,
me end up
right.
either start do foolishness on the chart then because
Yeah,
you
brother,
know
and
your body
you
need
don't want to do
rest.
that.
Exactly.
If you're sleepy, brother, you know so that can fuck you up.
Yeah, man. So,
1 second too
so
late or 1 second too early, you know that costs you so.
yeah, man. So that with me, you know, we end up start. I'm just give up on the London session and then now Forex did. And I say hard to trade, but sometimes the market kind of choppy. Trendy like how you see like how once Nasdaq or US 30 or any one of them like pick a direction. 90% of the time the stock market will go up unless we're in a bear market.
Yeah.
So you just need to catch you pull back them and buy and you will make money. And when you're in a bear market, you just need to wait until you reach it and catch you sell them. But Forex, today up, tomorrow down. Sometimes 1 week up, next week down. So you have to keen on your technical analysis, especially if you use ICT type of shit. So I really that. But me
Yeah.
still now and again, me just say me a focus on one pair. So mainly Nasdaq and SPX are US 30 me look on. So I'm not too mess with the Forex.
Yeah, bro. I like those two. I like those
Yeah,
two. Yo,
yeah. So
before we start this real quick, right?
mhm,
I want you to tell me what you think I should do. So watch this. I got a 2K tick chart.
mhm.
I got a multi-time frame chart. I'll show you that tomorrow. I don't know if I showed you that yet.
Mm-hmm.
It's the chart with like mad time frames on there, bro.
Yeah.
As a matter of fact, hold on. You can still see my screen, right?
Yeah, I can see it, man.
Alright. So you see this right here? This chart.
Mm-hmm.
This is a multi-time frame chart, bro. So every alright, so like let me zoom out. You see the inside candle?
Scroll up a little bit, like you kind of the half of the screen.
Scroll up.
It has show the browser top, so I don't know what the up at the top will make it Oh yeah. Yeah man, that's so good.
Good? Alright.
Yeah.
So you see the little candle inside,
Yeah.
like the actual regular candle
Mm-hmm.
them they are 1 minute. See?
Mm-hmm.
You see the orange part here and the green part,
Mm-hmm.
them they are 5 minute candle.
Mm-hmm.
You see big red part here, so
Mm-hmm.
them they are 15 minutes. You see big green, light green,
Yeah.
15 minutes. And then you see big red,
Yeah.
the big one, that are 1 hour candle. So with this I know brother you can
Um,
see inside how the candle are built to the hour.
oh, what you use with that?
But I know so we just there research you do on YouTube and time and we just make it
Oh.
just like basically programming for the Ninja Trader.
Oh.
Mm-hmm.
What
So
me,
brother, so me have the chart there, right? And then you see me have my 2K chart.
yeah.
My thing is, you know, want see how me fi split up my thing. Me I wonder if me
Mm-hmm.
fi really just what you call it now? If me have me have a 15 minute.
Mm-hmm.
No, alright. Me have three other chart on me thing. NQ, Dow Jones and ES. But me have one chart me switch from 4 hour to 1 hour to 15 minutes to 5 minutes. And then sometimes me I have to drop it down to 1 minute.
Mm-hmm.
You understand? So me I say now what you think? If we split that up and have two, like have one for the 4 hour and the 1 hour. And then have one for the 15 and 5 minutes, or you think me only need 5 minutes and 15 minutes?
But I'm me show you how me do my own. I tell you. So I have two screen. Yes, sir.
Yeah.
I'm a plan to get a next one to adjust the money and things to sort out that.
Yeah.
But I'm not sure. I'll send you a picture of my own.
Yeah, man. So that more and find out still. Because we realize, brother, sometimes me have be sitting there and draw, but and like I say, it get messy.
Yeah.
Understand?
You know. All right. Check your WhatsApp.
Is
This
any
is
call
how my
WhatsApp?
this is how my thing.
Hold on.
So them two screen they are two them two screen we are look on a 27-inch big monitor them. From the do it.
Yeah.
So starting
On the left
from your
side.
left hand side. So the top left hand side me have a 4 hour chart there. So the bottom left same way me have a daily chart there. So sometimes me may switch it to weekly, but me not really use the weekly time frame like that.
Yeah.
Beside the daily chart, me have a 1 hour chart, and then me have a 15-minute chart. up at the top middle section. And then up on the next screen, we have a 5 minute and a 1 minute chart. Me not have no tick chart, so me can't use it,
So
but
so
me use a
hold on.
1 minute. Yeah.
So go back to you say you have a 1 hour.
Yeah.
A daily and a 1 hour. So a daily fee it two are daily fee what?
So the daily for just Nasdaq. Just Nasdaq.
Okay. And then
But
you
me
say
can
yeah.
switch it, like me have both Nasdaq and SPX some. So I just one click and me switch it.
Yeah.
Yeah. So me have the daily chart for one, and then me have the 4 hour chart, and then me have the 1 hour chart, then me have the 15 minute chart. That up on one screen.
Yeah.
And then now over on the next side, me have the 5 minute and the 1 minute. Sometimes me interchange between the 5 minute and the what you call it and the 3 minutes. So me switch the time frame and look on different. It depends on how me I look. But me no come off of them chart. That's some me really trade it. So me see where the market a come at all times. Me see how price look on all time frames.
Yeah.
That's some me
Me
really
need
look
fi
on it.
yeah, me have to go sort out. Let me see
But
and
if yeah, the reason probably you combine for your one because you don't have as much green real estate. So like when me I run all the
and
Zoom,
even that brother, cause me have two screen too,
yeah.
Me have two screen and at the same time me use
But right now more two more,
yeah,
two
me
more
need me feel
screen.
like say me need one more screen. We just
Yeah, more,
have the 1 minute for everything, the 5 minutes for everything, and the 15 minutes for everything up one time.
yeah. But you see thing about it still, you see you are just one pair me a trade at a time.
Yeah.
Me no need to look on the multiple pair because it can be distracting for your try if you look on so much of them.
Yeah.
Cause I always think that me need to look on whole heap of pair. When me just start trade, me usually have a 10, 20 pair for my watch list. And me a trade for it. I cut it down to five,
Yeah.
till me cut it down to two, and then me cut it down and me say, if me a trade forex, either me a trade GU or EU, or if me a trade indices or futures as I call it, me a look on NAS and SPX. The reason why me not really trade SPX is because the spread them kind of wide up on my thing. Cause for your thing you know have spread. For futures you know really have spread. But for my thing it have a spread because it have a bid and a half. So sometimes if you don't mind where you get in at a bad feel, especially when the price are jump up and down. But NAS give me a better spread and NAS give me a bigger move for the day. So when SPX would have move, like say 20, 30 points for the day, NAS would have give me like 300 points.
Yeah. Yeah. You
So
see,
that's
my
how
thing is I trade the SPX, but you see, it's not that I'm trading. I trade the SPS and the Nasdaq, so I'll jump back and
yeah,
forth between those two.
yeah.
But more time, I'm really focused on the ES. But you see, the thing is, I've learned that the Dow Jones has a pull on this shit, bro.
Yeah man. Yeah man,
So,
because
so
I don't know if you know about the stocks them, but remember I know NAS 100 have 100 tech, basically mainly tech stocks in it. And then now the Dow have 30 industrial companies. So like Boeing, Caterpillar and them things. I think one bank in it and something.
yeah, and they
But at
overlap.
the top, yeah, overlap. And then now the Nasdaq, now SPX, S&P 500 have about 5 or 6 sector. And then now after the top 500 company them in it. But sometimes in a recent time, they must switch up the company then where they in a SPX. So
Yeah,
if you not have a market cap of a certain amount, then them are gonna drop you out right. So you have to perform and you have to have a certain market cap.
yeah. Well, yeah, man.
So
Like me say, man, let's start you. So, all right, you ready?
yeah.
I know.
Yeah man, when you're ready, man.
All right, like me say, make sure you can hear, you know.
Yeah man, yeah, man.
Let's go ahead and hop on a chart. This video is going to piece together everything that you've learned about.
So, like me say, brother, me I just happy. Whenever me see anything when me think like me want to explain to myself again, never stop me.
Yeah,
Anything where you feel like say you know you have little more knowledge than me, you just tell me and
yeah.
me stop. You see?
Yeah man.
Alright.
the ICT into an easy to follow and simple strategy that you can actually use in order to trade. Because as with ICT, as you can see, there is a lot. We're going to be going over everything from market structure, fair value gaps, liquidity, order blocks, breaker blocks, time and price, daily bias, market maker models, S&P convergence, and then how to put it all together. So this is going to be a long video, guys. This is going to replace most of the education that these guys are selling as a course. They just make it a more overcomplicated and long than it needs to be. And while ICT is valuable, 80% of what you learn going through all the content you'll never use. So what I've done is taken everything that I've learned over the last couple years and stuff that I've used to make over 7 figures and put it into an easy to digest, actionable free course. So let's go ahead and get started. The first thing we're going to talk about is structure. Okay, so of course, what is structure? Why do we use it? And how do we use it? So some of you guys are going to already know this. That's fine. Feel free to move forward in the video, but I challenge you to watch this because I guarantee there's something that you may have thought you knew, but you actually don't. So what?
That too fast. No man, that good man. You can full screen
Many of
it
you,
to make it bigger. Yeah.
Better.
Yeah man.
you know this, but it is just highs and lows in the market. Okay. Now the key is knowing which highs and lows to select and which highs and lows to pay attention to. You have to have a practical method of finding them. Otherwise, you're going to be paying attention to every single high or low on the chart. Now, why is market structure important? Well, market structure is going to be the foundation of your analysis. Okay, everything that you use is going to be used in context of market structure. This is going to be involved in every single concept in some way or form, and most people still somehow do it completely wrong. You see, if you're just using candle closes or you're just using, which highs and lows are being made to map market structure, I can go ahead and guarantee you that your trading will be very, very hard and you're going to have low probability setups. So first, I want to talk about a concept called manipulation and displacement. Now, this is what really made trading click for me because everything that you're doing with ICT revolves around one thing, right? That is that we are trying to figure out where smart money is going to trade. So in a range, if we have market structure forming, okay, and then we want to determine which way the market is actually going to move, it's not going to be just every time a new high or low is made, okay? It's whenever the market is taking out liquidity, right? The whole idea of being an ICT trader or a smart money trader is learning to trade with the smart money. So let's just say smart money wants to get active in the market right here. Well, smart money is going to need a lot of liquidity in order to get active. So what they will do is they will manipulate the market to where stop losses are, usually under the low of a range or a very clean low, oftentimes with key levels like fair value gaps below it or breaker blocks or order blocks. We're going to get into that later in the video. But they're going to manipulate price to an area where there's liquidity. So if the market just barely taps into an old low, right? Barely taps into it, it doesn't close, or even if it closes a candle just beyond it, but it doesn't displace, it doesn't create any fair value gaps, it doesn't create a forceful push through the low, not just to it, but through the low or the high, and then it starts to reverse, that is manipulation. Anytime we see manipulation, we expect the market to move in the opposite direction, because if the market is being manipulated, right? We all know that the markets are manipulated. We can all agree on that, whether or not you agree with all of the ICT stuff. But if markets are manipulated, then we're going to...
Yo, so you see, for me, before I knew any of this, bro, before I knew any of this manipulation or whatever, let's say this box right here, right? This would be my range. I trade a strategy, something called two-legged pullback.
Yeah.
So what I would look for, I trade something like this type of motion right here. You see that?
Yeah, yeah.
So, bro, I didn't know nothing really about liquidity. I didn't know nothing about that, bro. So the first time I made cash from trading, bro, I didn't know nothing what I know now. You understand?
Yeah.
So, bro, I would trade something like this. It's inside the range. It's inside the range. You see when it does this breakout right here?
Yeah.
For whatever reason, all the strategies I've learned from all the people, either Thomas Wade or Pats, I would wait for this thing right here to reverse and take it, and then we'll call it a fail breakout and look for it to hopefully keep going, or bounce off the top and keep going. So, bro, I'm trading all of this same thing now that I'm learning the terms for, but I'm doing it without knowing basically what I'm doing.
Yeah. So the Pats guy, the guy where do one review thing or even time on
Yeah,
YouTube.
bro. So
we used to watch him from your trade stocks for a long time, you know.
Yo, bro, I promise you, bro, you should watch this guy every day. And that's the type of shit I'm talking about, bro. The grind. It's an everyday thing, bro. We gotta find a way to get that in our day every day. We gotta find a way to trade, follow our process during the day. You know what I'm saying? That's our job. After that,
Yeah.
bro, we got to review our trades for the day. Then we got to review the market for the day. Then we need to watch those type of people prepare and review for the day and then prepare for tomorrow. I mean, like I said, people think it's an easy thing, but I think this thing is more of a job than some
Now,
jobs.
man, this is rough, brother. If you know, like enough people me meet on the journey, them couldn't manage it and trust me.
Yeah, bro. I
And
always,
lose $1 million, then lose 100,000 and then cut. And I tell her,
yeah, but I'm telling you, I be joking with my friends. I be saying like, yo, I think yes, every job is hard, but if you learn it, you can do the job, whatever. You can make it. This is not like that.
I for real, man. You will do everything right and still lose, man.
Yeah, bro. Not everybody can do this one.
It's a zero sum game, as them say. So,
Yeah, bro. But yeah, bro. So a lot of this now, I feel like I'm learning the terms and why I'm doing certain stuff. You feel me?
yeah.
So yeah, man.
To want to fade the manipulation or trade against it. So if we deem a price like manipulation, what we're going to do is look for reversal to the opposing liquidity. Now let's just say if the market manipulates a low or a high, and then we start displacing, right? What displacing means exactly the definition of the word. Just displacing, a very big energetic push through structure. So let's say if the market pushes through structure, it's going to create fair value gaps. And once the market returns those fair value gaps, we can expect it to continue as long as the market is displacing. So understanding what structure the market is manipulating and what structure is being displaced gives you everything you need to know in terms of directional bias. Now, this is also known as internal range liquidity to external. We're going to talk about that later in the daily bias part of this video. And I'm just going to go ahead and throw this out there. If I say a term that you don't know, go ahead and rest assured because it will be covered in this video. I'm going to go over everything A to Z that you need in order to trade profitably with ICT. So to review, manipulation legs fail to displace or push rapidly beyond structure, and displacement legs, well, they displace or push rapidly through structure. If you get manipulation, you're going to look for reversal. So notice right here, the market pushed up through a high, and we did not form any fair value gaps. We didn't get a real energetic push. And what happened? The market reversed. Now, notice the reaction was this low. The market displaced through it, creating a fair value gap right there. And it continued, right? The market, whenever it displaces, it's going to continue, okay? Until we get manipulation, like we got right here. And then what happens? The market reverses. Not only do we get manipulation, but we got displacement. See how we created a fair value gap right there? So you could pair these two concepts together to get extremely high probability trades and understand which way the market's going. I mean, just look how consistently this works. We get displacement, we create a fair value gap. Boom. Displacement, we create a fair value gap. The market does what? Continues at least through that next high. That's all you're looking for. Now, as soon as the market starts manipulating, like it did right here, didn't form a fair value gap, we can then expect a possible reversal. Now, you can go on lower time frames and view this little bit of price action, and what you're going to see is a displacement to the downside on the lower time frames, right? Now, this is how you're going to use structure to get bias and to confirm other ideas. Because at the end of the day, that's really our job as ICT traders, or really any kind of trading, is you have, your key level, which you're expecting as support or resistance, and then you're using some kind of confirmation method. Our confirmation method is going to be manipulation plus displacement. Now, if you just use one or the other, it's lower probability. And at the end of the day, we want to make sure that we're taking the highest probability setups. And not only are we going to pair manipulation and displacement together, we're going to pair it with other concepts like fair value gaps, time and price, and numerous other things that we're going to talk about in this video to get the highest probability than when used alone. Now, this is where most ICT traders struggle, is because they know all these concepts, but they don't know how to put it together. And that is what inspired me to put this video together. So you just have the one video to kind of finish everything off and to put everything that you learned together. If you want to download this entire board all for free, that way you have all of the examples, you have the mind map, all of the ebooks and everything, you go ahead and click the link down in the description and download it right now for free. Next, we're going to talk about a concept called impulse structure. Impulse structure is structure that forms with displacement and fair value gaps. Now, I want you to go ahead and repeat after me. Not all structure is created equally, okay? If you notice in this example over here, notice how the market has these big displacement legs. We're going to imagine there's a fair value gap here. There's a displacement. We push rapidly through a low. We're going to imagine there's another fair value gap there. But then look at this structure right here. Like the market's making higher highs, but it's not very rapid. It's not really pushing through. So that is manipulation. We're not going to even consider that structure. In fact, the only structure you're going to consider is going to be the current impulse, because that tells you what the market is reaching for. When the market is displacing and pushing forcefully, it is reaching for something. When the market is manipulating and it's not pushing forcefully, it's usually just grabbing stop losses only to reverse. Okay, so this red right here, this is the higher time frame. Now, the green is going to be what the lower time frame looks like on every retracement into an impulse. So we have impulse right here creating a fair value gap. We're just going to imagine there's a big fair value gap the market's pushing into. And then on the lower time frame, you're going to use this impulse structure paired with other concepts we're going to talk about to dictate when the market is likely to reverse and continue on impulse. Because like we talked about, if the market impulses, right, if this market impulses right here, Whenever we come down, we're expecting it to do that again. We're expecting it to continue. Because remember, displacement equals continuation. So if we know that, we can use the lower time frames and use things like market maker models and internal and external range liquidity to get daily bias and find trade setups. But the foundation of all of this is understanding manipulation and displacement along with impulse structure. So always remember that higher time frame impulses equal many lower time frame impulses. Okay, it's going to be a lot of noise and a lot of structure in that lower time frame. That's why it's important to always use it in context of what the higher time frame is telling you. Okay, extremely, extremely important. Now, I want you to not even pay attention to any structure that isn't manipulation versus displacement or viewed as an impulse. So, for example, the impulses here would be this, right? And then this. None of this, right? None of this is even paid attention to. You're in fact just looking to sell above the highs with confirmations that we're going to talk about later in the putting it all together part of this video. But you're going to be just looking to sell above highs since the overall impulse is bearish. Now, we're going to use another tool called premium and discount to determine where the market is likely to reverse. We're going to go over that in just a second. But I want you to always remember that all trends come to an end, and the way that we're going to gauge when impulses are likely to retrace or likely to expand is going to be a mix of premium and discount and then something called internal and external range liquidity. So I want you to think about this. If trading is a business, then candles are your product. Now, if you have a product, do you want to sell it for a premium or do you want to sell it for a discount? Obviously, you want to sell it for a premium. Now, if you want to buy your product, do you want to buy it for premium pricing or do you want to buy it for a discount? It's pretty obvious, right? But people don't think about this when they're trading because they're impulsive. So I want you to always take out your flip tools and mark out your impulse structure and pay attention to that 0.5 value. The settings you're going to need in order to do this are found right here. This is a trading view. You just go to the fib retracement tool, and you just mark these settings. What that's going to give you is what it looks like this. It's just drawing the midpoint of a range. Anything below that is a discount. That's what you'd look to buy if the range is bullish. Anything above it is a premium. Now, just because we have premium discount doesn't mean it's always going to be sell, sell, sell from premium or buy and discount. You have to use the context, right? Notice how the market is bullish, right? The market's moving up, so we're looking to buy in a discount. And if you are scalping selling anywhere down here, you would be very wary to do so once we get closer to that midpoint. Because again, remember, every trend comes to an end, and using premium discount gives us a high probability of being able to determine where that trend will come to an end. All right, so let's go ahead and talk about fair value gaps. So we're going to talk about what they are, why we use them, and we're going to go over a simple and easy to use strategy because most of what you've learned is way overcomplicated and unnecessary. First off, a fair value gap is just a 3-candle formation with an expansive middle candle, causing a gap between the wicks of candle 1 and candle 3. So in this example, we'd have candle 1, right? Then we have candle 2, and candle 3. Now notice this middle expansive candle leaves a gap between this wick of candle 1 and this wick of candle 2, or I'm sorry, candle 3.
Yo, for me, since I'm still learning, I just be calling what I call a space bar.
Yeah.
You know? Like that's what I call. This is how I started first remembering it.
Yeah.
So I need this one candle right here. I need this second candle to give me the space. So I call it the space bar. And then I need the third candle. And then I just say the high of the first bar and the low of the second bar. Right? It's the same thing that he's talking about, right?
Yeah.
And then you would want it. I think they were saying the main thing. You see, I'm trying to use this for my review too. The main thing is if it's gonna work, you want it to hold. Let's say this is the 50%. So you want it to come in here and then go back up, yeah?
Yeah.
And then just again review. They would say this is not a good one because it has a bearish and then a bullish candle, right? It's still a fair value gap, but they say something like it's not as strong because it's not.
Yeah. But the thing about it, when you do, ignore most of them. Some of them, well, not most of them, but ignore some of them rules. Because I see that way it come in like same way and fly up back or push up back in it and drop. All the man say it have to do with like context. Depends on where exactly in a price it there and like the time where actually coming with them.
Yeah. The time. So, yo, that's the main thing. That's what I said. You see, I read it the other day. He was saying something about how he looked for a specific time.
Yeah.
So I started looking for a specific time. For me, bro, between 9:50 and 10:10, a move starts to generate. A move starts to happen, yo.
Because I'm telling you what the timing thing I come from like the session open them and the when certain market open. So like if you Google them, somebody actually come across them. So when we Google them thing there, then tell us 9:30 New York time, the stock market open. Before that, you have the pre-market. You have the time when the CBOE come on. You have the time when the Nasdaq exchange. You have the time when the ARCA come on. So them come on at different time in the day and things. So I guess at the time thing come on, you know. So me kind of look out for even the candle close them and them thing. They can have my indicator when me use for my thing, you know. It mark out all of them thing there.
Right.
So me look out for it, but it is more significant to me when we did a pre Forex because you have London open and then you have the London kill zone, you have Frankfurt open, Frankfurt then at Germany and thing. And you have the New York open that have the New York session. And then now you have the close time them. So you have New York close and thing. But true we just a trade equities. We just look for the opening bell, 9:30. In between 9:30 and like 9:30 to about 10:30 there, so you always get a nice setup there, so.
Yeah, bro, I'm telling you. And then I start to realize, bro, between 1:45 and like 2:15.
Yeah, that's after lunchtime.
Yeah. So, bro, I really want us to focus on trying to see if we see these gaps because I'll be starting to break down the days into the session. So,
yeah,
like,
man, mark them out, man. I think mark them out.
Huh? Yeah, bro, you should put them one day. You should put them one day, so we can have them.
Alright, look, yeah.
Yeah, man. Alright, I'm gonna keep playing this right now.
Yeah.
Same right here. Candle 1, 2, candle 3. And there's a gap. It's just a gap that big expansion leaves. Now, we expect the market to return to this level, and if in context of impulse structure, we expect it to move up, then we can use lower time frames to confirm this. That's where we're going to get into market maker models earlier. But right now, just focus on impulse structure and fair value gaps. I want you to remember that fair value gaps show displacement. This is a reoccurring term you're going to hear me use, and if you've been a part of my audience for any amount of time, you know that displacement is a big part of my trading. And the reason that I think it's so important is because it eliminates half of the noise, and it's going to eliminate half of the bad trades that you take. I mean, just think, if you were able to eliminate even half of the stupid mistakes you make as a trader, how much more profitable would you be? You're welcome for your daily dose of pain. But you need to think like that because that is what trading is at the end of the day. It's just eliminating errors more so than trying to add on higher profits and higher returns. It's always about refining. And fair value gaps and displacement are going to help us do exactly that. So what they do is they show a desire to move further, okay? We can use fair value gaps for everything from higher time frame levels, directional bias, trade entries, and stop losses. And I want you to understand that some fair value gaps have a higher probability of continuing than others. As with anything in trading, nothing is 100%. And in fact, just because this is a fair value gap doesn't mean that it's high probability. And in fact, neither of these are. They're actually both very low probability. Now, the reason I chose these, and now I'm telling you that, is to show you that you can have a concept and it still be lower probability. So many times I see traders figure out a new concept, and then every time it pops up on the screen, they want to go and trade it and wonder why it's not working every time. And that's just because they don't understand trading, and they don't understand that trading is a game of probability. So you're going to be stacking different things, aka confluences, together in order to get higher probability. So why do we use fair value gaps? Well, number one, going back to our example of displacement, right? Fair value gaps show us displacement. Like we talked about before, we need a fair value gap to confirm a big push in the market and to confirm that the market is going to continue. Now, another concept that I've hinted at was internal range liquidity to external range liquidity. These are just abbreviations. So notice how the market is going to be moving from one of two things. Okay, it's either going to be moving into a high, right? This, and whenever it turns around, it's going to move into a fair value gap, which is internal liquidity, and from there, it's likely to move back to a high, and it will continue on this course until the market is going to reverse. Usually, the market reverses when we don't have fair value gaps. For example, look right here. The market moved from external liquidity right there. Where did it go? Internal in this fair value gap. Went to external, but then notice there is no fair value gap here. So then the market reverses and goes to external range liquidity. Now, fair value gaps are used to define internal range liquidity, and they're also extremely valuable whenever you're trying to find bias. And if you've been trading ICT for any amount of time, you understand that daily bias is 100% the hardest and most subjective part of this whole ideology. But we're going to talk about how to simplify that as well later in the video. For now, I just want you to understand that the market is going to be moving.
Yo, how true do you think that is?
Huh?
How true do you think that is?
Yeah, man. Real, man.
So it only moves from a high or a low or a fair value gap.
Yeah.
Wow.
That's why Friday.
Yeah.
Friday, you realize after the market has sell off and I say, yeah man, once they break this a low, yeah, it's a go weird on here. So if you pull up the chart, it have a level there when you mark out and it tests it and then it bounces a little bit. and then after that it push through it. So anyway, you see, like that's why you hear me talk about the highs and the low, the equal highs and the equal low, them and them thing there. As a matter of fact, all of the highs and the lows, them have liquidity. And that's so me and you set the stop them. And that's so everybody set the stop them. So them will come for the liquidity. So that's why anytime you see it drop through a low, them either bounce it back because people have sell stop below, like that low they wish by a mark there. So you know?
Yeah.
So sell stop meaning say if the price break through it, it will continue sell. So people have the sell stop below the thing, and they know when you go in it bounce back because you have people where you buy, where see them buy close out and it cause a sell just the same.
Yeah. Yo, this is crazy. I'm looking at this because this thing takes out this high, and then now, okay, so you're telling me once it takes out the high, you're just looking for it to either come back here,
Yeah, or the other block,
or this one, or this is okay. So the order block would be
the black candle.
this candle right here.
No man, all the way at the bottom.
This.
Yeah, that one. Yeah.
So you would think it would come back there.
Yeah, man. Yeah.
Interesting.
At some point in time, it can come back.
Yeah, but because it doesn't get that far, it just goes and comes back to this one right here.
Yeah, that all depends on the time frame, you know, because that's why I'm do the chart them, so I'm not show you no time frame. So you don't know if that is a 5-minute chart or a 1 hour or a daily chart. So that's why I do it so.
Yeah, so you just gotta be looking for it.
Yeah.
Alright.
Fair value gaps to highs. And then
Wait, did I say something else?
No man.
Back and forth and back and forth. Now, lower time frames, like we talked about with the impulse structure in this example, this is a visualization of us moving from those fair value gaps back to external range liquidity. We're going to use something called market maker models to determine how to trade this later in the video. Let's talk about some strategies on how to select which fair value gaps are high probability versus the lower probability. Now, if you notice right here, these are the examples that I showed you earlier in the video. Now, there's going to be something called a lack of consistency here, but what is that? So I want to drill into your head that you need to do everything you can in order to refine and weed out the bad trades. Okay, so this shows the lack of displacement.
That's what we want to talk about this, huh?
Yeah.
Alright, yesterday, look for the second fair value gap, the smaller one. You realize say, you realize that the one candle come in and can give you a reaction.
This one.
Like, look to the right now. You see? Yeah. That is the reason why enough time when you and I don't remember the next brother them name. I don't learn them name.
Gavin.
That's why enough time when when I look to take some sell, me I say, yo, you better wait until it break this because you see, even though it's not a high probability fair value gap, you see if you jump in and sell this and it push through it have a probability, a high probability so it will give you a reaction. So you see, if you're not quick on the trigger, it end up bounce back and you don't realize. Me now say you not go sell through it now. But just the fact say one fair value gap this up.
So me no really selling on them sitting here.
Yeah. So you have to be careful which part
Yeah,
you take the
and
trade.
for me, that's what I said. Me wouldn't sell you so, because you see the little bullish space here. Me wouldn't sell this. We feel
And then
like
now
if anything now when me I look for it, me would have see try pull back in here so I'm able to try and sell you so.
yeah. Once you break through one, you can sell it, but
Yeah man.
you have to wait for the candle for close through it. But and
Yeah.
next thing when we do, we take a chance and get a buy scalp there so.
Yeah.
Because me move say there are 90% chance me know say it will give me a bounce there so.
Yeah, yeah. You see me now.
It will give a reaction and if it's a big fair value gap, trust me. Remember say most time you only look for like 1 2 or 1 3 or 1 4
Yeah,
or
yeah,
1 5
yeah.
point.
This is where you scout, but you know,
Ah,
I'm still working on for buy the candle them before them close. You see whether in a my strategy me wait for candle close. So I said,
no, but me do that too.
yeah,
Me do
yeah.
that
So
too.
right, that's me wouldn't even be able to take the buyer. You see what I say?
No, but
Because
more than likely,
yeah.
may I assume say that wouldn't be like a 1 minute chart. That would be like
Okay,
a one
okay,
hour,
okay.
15 minute
So
chart.
you say when you go down into the lower time frame, you
Yeah,
find some way to
yeah.
get out and then get back out
Expects
right
me to
now.
go bounce. So like that could have be like all a 5 10 point bounce right there.
Yeah,
So
bro. All I need for my scalp for my day is 2 points for ES, and when I'm trading MES, I want a 10-point move.
that's all.
That's it.
Yeah, man. So that the look of favor to get this up on all a 15 minute or a 1 hour chart could have give that.
Boom.
And you do.
You get that, and you good.
Yeah.
Much as it
And
may
if you
get one
realize
move
that
down.
after it break through, it give a retest on the next side.
Yeah.
Yeah. The inversion. So that tap I see him fair value gap and just tap back in it and just it's like a kiss goodbye and then it just drop back.
Dead.
Yeah,
Yeah,
man.
that's vicious right there. I seen
Yeah,
them
man.
say something like that, but there wasn't a candle between. It was like a volume imbalance,
Yeah, that is the next thing. That is the next.
like the
It's
fair
a type
value
of
gap.
fair
But
value.
yeah,
Yeah,
but I thought this was it, but I didn't see a candle in between on the picture. I don't think so.
yeah.
But what about this little thing right here? This is nothing up here to try to look at.
In terms of like a fair value gap too.
Yeah,
Yeah, man, there's a fair value gap there so too.
yeah. So
But
like
between
for
just
me,
to highlight the one them a come down like the bullish one them.
yeah, I would try to
That's
sell
like
right there.
yeah.
I would sell right here, put my stop loss right above here, and I
Yeah,
would
man.
target this low, or obviously this, you know.
Yeah, man.
Yeah. All right, good. I just have to make sure.
Yeah.
Let's go.
Can reverse engineer this idea. If you have inconsistency gaps and maybe an impulse down like this, you can pair those two things together as a confluent to look for lower pricing to probably trade into liquidity. Okay. Another big thing that I want you to learn is how to reverse engineer concepts. Because if you understand, oh well, this is low probability, I'm not going to buy here. Well, if you're not going to buy, there's a good chance that there's a selling opportunity. Now you want to make sure to pair it with other concepts like impulses. Right here we have that impulse with displacement, and numerous other things you're going to learn in this video, and it's going to open up a whole new world of opportunity. Next, let's go ahead and talk about break and structure gaps, or BSGs. So break and structure gaps are extremely important, and they're a tool that's going to help you determine whether or not the market is going to continue on its displacement. Even if it's an old break and structure gap with old structure, you want to pay attention because that fair value gap took structure, right? It was a candle that broke structure, so it's very, very important. It pushed us across a line at one time. So if the market comes into this fair value gap and it's a one-sided gap, look at this, we have down candle, down candle, down candle. That would be 2 times the probability. Now, I'm not saying every fair value gap that is a break and structure gap will work. And in fact, if they get inverted, which we're going to talk about inverting fair value gaps later, if they get inverted, you can actually use that as a tool to trade in the opposite direction because if the market is going to continue, this fair value gap should hold. So if we can pair together having both one-sided gaps and break and structure gaps, those are the highest probability fair value gaps, okay? You can just have either only a one-sided gap or only a break and structure gap and it works. But the higher probability is when you combine them together. That's another concept that I want to push into your mind is that if you combine things together, you're going to have more confluence or more confidence in a trade or a bias or whatever you're trying to draw out on the chart. Just like we just talked about, if you fail to break and structure gap, we invert it. Notice how we close above it. At that time, you can immediately look for the market to trade higher. Okay, immediately look for the market to trade up into the liquidity beyond that fair value gap because if the market was bearish, we should not have inverted that. Okay, you can see right here when the market inverted that, the market then uses it as a level of support. and then trades higher. Okay. Now, inflection points are another confluence you can use by extending out the structure that was taken and seeing how the market reacts at that level. This is something that you want to use. Think of it like sauce on your meal. It's not the main course. It's just something that you're going to sprinkle on or add for extra confluences. Okay. I don't want you guys to get too crazy with inflection points and just draw them out and only use this, but they're just an extra confluence to use if they are coinciding with other levels. So all this is extending out the structure that was broken with the Bredrin structure gap. Now let's talk about inverted fair value gaps, and these are extremely powerful. Okay. Inverted fair value gap is simply when the market closes or inverts a fair value gap. There's an old saying that ICT used to say. It was that the wicks do the damage and the bodies tell the story. Now, what does that mean? Well, in a fair value gap, it is okay to see wicks into it. That doesn't mean anything that the fair value gap is going to fail. It's even okay to see a body close inside of it. But if a body closes outside of it like this, the market is likely switching direction. Now we're going to talk about how to use this as an entry strategy, how to use this as a buy strategy, and everything in between. To increase the probability of an inverted fair value gap, look for them to occur at two-sided gaps, since we're already expecting those to fail, or at break and structure gaps, because those should hold. Now another thing you can do is look for them after sweeps of liquidity, like we're talking about. Let's say if you have a manipulation. You have a manipulation, and you don't want to have to wait for this whole displacement to happen. Let's say you get an inverted fair value gap, but you haven't really got a displacement. Well, you can use that in place of the displacement because it's just something that is helping you rationalize that the market is likely going to trade lower. So if you had this plus displacement, it would be even higher probability. Okay, you can stack these things or use them interchangeably. Now, when an inverted fair value gap is confirmed, look for the opposing liquidity. Let's say when this fair value gap was inverted, we formed liquidity there, the market traded up, traded lower. Okay, now if you want to pair this with your overall higher time frame, like we're looking here, let's just say the market had inverted a fair value gap right here. Well, if the market inverted that, let's say it closed a candle right there. Okay. At that time, you didn't just have to look for this opposing liquidity. You could pair it with your overall higher time frame impulse to look all the way up here. You can see that that's a massive difference in terms of your overall target and the amount of money you can make off that trade. All right, so now let's talk about liquidity. This is something that gets overcomplicated, and I'm going to simplify it into really all you need to know. We're going to talk about what it is, why, and how to actually use it. So liquidity, definitively, is the ease at which an asset can be bought or sold. Remember we were talking about the example up here. If you were a large market participant, let's say, wants to buy a gazillion shares right here and they're not for sale, you're going to have to manipulate the market down to where they are, because there's ease of buying down here. There are enough shares or enough contracts or whatever you're trying to buy. If you're a market maker, there are enough of that down here for sale in a liquidity pool. Right? There's a pool of liquidity. Okay, so that is what liquidity is. Now, why is it important? Well, if we are trading smart money concepts or ICT, we're trying to trade as a smart money. And where would the smart money buy in a bullish market? Well, they want to buy from sellers, right? They have to push the market where there are sellers, which is going to be under lows. Okay, so if we are bullish based on other things that we're doing and on the chart to form bias, then we want to buy under lows, aka sell side liquidity. Sell side liquidity just means under lows. Okay. Now, in a bearish market, we want to sell to buyers, right? Where are there going to be buyers? Well, there's going to be breakout buyers. If the market moves above a range, people are going to try to buy the breakout. But more importantly, there's going to be people who are shorting, but then they get stopped out, and that is the equivalent to a buy. So if you're bearish, you want to sell above highs, and if you're bullish, you want to buy below lows. Now, you can apply this concept in a myriad of different ways. For example, whenever the market is impulsing up, remember we have these examples where there's not really any structure we don't pay attention to. Those are the lows that you want to buy under. Okay. Going back to this example, which we're going to revisit a couple times. Let's say if you were bearish in this market right here, you would be looking to sell above these kind of highs because the impulse is bearish. So anytime you're popping above structure, sell above that high and then ride it down to the next level. Vice versa.
Yeah, I used to have a little hard time with this, but what helped me is started looking at the daily candle.
What?
Like I used to be like sell above highs, buy below lows. You know, at first it wasn't clicking, but when it's all clicked, when I started realizing, okay, I like to take a short on a bar like this. Right? That's the candle I like confirmation. So then I started realizing this is literally you selling right here and looking for it to make that dive down. But they gotta basically catch them offside right here.
Yeah.
And you gotta be willing to call that.
But when you still alright. You see, even though you see the market push above a high, that's like them call it a liquidity run. Like as soon as it take the high, it normally pull back, especially if it's a major high. So it's like a all high, yeah, look for, not the most current one, so the all high, like to the left of this. So as soon as it push above, normally give a pull back. That have to catch the breakout trade of them.
Yeah.
So like remember, if you look to sell on the market, push below the low. will catch you if you just sell. Because them will take profit and you just jump in at the sell and you expect the price will go lower. And you get caught offside. Same thing apply to the buys. So if the market a buy a go up, you can jump in and sell when it a push a go up. Because you expect it to go sweep the highs and then jump. But you go understand still.
So but you want the displacement to confirm it. Or the no displacement. So if I'm looking for it to turn back, I want to see the candles with a bunch of wicks and everything overlapping.
Yeah. So based on that picture that we just posted a while ago.
Huh?
The picture we just posted say sweep.
Yeah. That's what I was saying.
So you can sell after I grab the highs.
Yeah, you know, like it's like right here.
Yeah.
You know?
So you wait for it to retest. So you know if you catch that the first part then, you see when it break down.
Yeah.
So yeah, when it break this up and it come back on retest, yeah, you get to sell this out our next year value gap.
And that,
or break a block or something.
This would be that unicorn trade, right? Because it's the bottom right here, it's the order block probably right here. And then you got this new fair value gap. And probably since it bounced right here, this is an inversion too, right?
Exactly.
So it's just this one is everything. This is the prime time one.
Yeah.
Okay. You just be patient and wait for this key level right here.
Yeah, man. That's the key. Then you lower the boat like you can throw on 10 lot on that.
Yeah. But so if you're in here, that would be sweet. But then you just keep add here, and you add right here.
Yeah.
And you really try to target down here is the main target, but 50% of this, I would even just target here.
Yeah, whichever, like, you think about it, me always not tell people when to take them profit, because that's why I say me use a tool and me can close half or close quarter as soon as it push off. So, like the take profit thing, then say you never go broke taking profits. That's one thing.
Yeah. Yeah, you just don't want to take them too early though. You want to make sure you get
the risk not too reward. Early, but
Yeah, I want to get that risk to reward. I've been working on that.
Yeah.
But you see this? Yeah, I'm showing my cousin. So you see how this was a low right here? Right? So look how this is a short-term low. They went up, they broke it. Right? They broke back down, showing that now we're not going up. And then they came back and retested it. And then when they retested it, they got rejected. See that? That's a key area. And then we want to look for that fair value gap, the thing with the three candles, right? Remember? Like this. And then like this. Yeah, you were going to see, come down, retest that too. And then you want to see one right here as well. Come back, get retested. That's what he's saying. That's like a. Right here. A space in between. Yeah. In that area. Yeah. See what I'm saying? Let's go. You got anything else, Gennaro?
Nah, man, we're good now.
First, if you were bullish right here, because the market is impulsing up, you would look to buy below lows because you want to buy below lows. Ideally, at key levels like fair value gaps or any of the other levels like order blocks or breaker blocks that we're going to talk about here in just a minute. So back to this example of internal and external range liquidity. We're not going to sit here too long because we already went over this, but external range liquidity is just going to be highs or lows. Internal range liquidity is fair value gaps. Okay, very simple. The market is moving to one or the other at all times. You can go from the top down in order to get a clear bias. You always want to start at a higher time frame, like a weekly, and then move down until you have clear bias. Okay. All right. Now let's talk about order blocks. A lot of people, including myself, whenever I first got introduced into trading ICT or SMC, got introduced through order blocks. They get introduced through supply and demand and all these super high risk reward strategies. And most of that is just complete BS, okay? I'm going to crack the code on how you can actually use order blocks and how to properly use them as an ICT trader. We're going to talk about what they are, why, and also how to use them. Which I came up with on my own after spending years and years in front of the chart. So what are order blocks? Well, order blocks are candles formed just before expansive moves in price that can be later used as a level to trade from. So if the market is trending down, and let's just say you have an up close candle right here. This is an up close candle. If the market is still bearish, you should find resistance on that candle. So you can use this as a level to trade from. Let's say if you were in a trade from above, you could trail your stop above it. There's a lot of different uses we can use order blocks for. That's why they're important and what they are. So in a bullish market, it's going to be down closed candles, and in a bearish market, it's going to be up closed candles. Ideally, ones that occur before a fair value gap, and they occur before a displacement, because displacement is everything. A level should provide displacement if it's going to be respected. All right. So let's break this down a little bit further. So order blocks are going to be critical price ranges where institutions engage with buying or selling against retail trends. Okay. So remember we talked about taking out liquidity. So if the overall institutional bias is bullish, right? The big dogs want to push price under a low, they're going to have to sell and create that manipulation in order to do so. So if the market pushes all the way down here and they're selling, they're going to be in sells that are underwater because their main position is buys. Let's say they're 20% in sells right here, and then 80% of their books are net long. So when the market gets pushed up, they still are underwater on these sells. So when the market comes back to those areas where they're in sells, they're going to mitigate their losses and close those sell orders, which then in turn creates a bullish reaction. So that's the why and how order blocks work. So it's going to be the lowest candle with a down close that has the most range between the open and the close. So ideally, you want to just use the body, right? It's just mapped out to map this candle just to show you it's this candle, but you want to use the bodies, the open to the close. You want to find the one that has the largest body before a move up in price. Also notice how there are fair value gaps created after it. That shows displacement away from it, okay? Now in a bearish market, it's literally the same thing, just the opposite. It's going to be an up close candle, okay? So let's look at some more examples. We have a support level that is taken out, so liquidity was swept, and the market started.
Sometimes it's a little tricky because the bullish one is actually the bearish candle, huh? The bullish one is the bearish candle. You don't see that? Right, Jay?
Huh?
The bullish one is the bearish candle.
So it's a alright, like for the up one,
Yeah, going up.
when it's going up, it's a sell before the buy.
Right. So you see,
And when it's going down, it's a buy before the sell.
it can be a little tricky. Yeah, it's reverse. When what you're looking for is this bearish candle. Remember they were selling. This last sell candle, you want to see it go up, retest it, and then go up again. The last sell candle before it start going up. So like, example on this one here, maybe this candle. This is the last sell candle before they just start going up. Right? You see, so it's always this like this last one, then it start going up. Right? And then when it's coming down, it will be this one because it's the last bullish candle before it start going down. Right, yo?
Yeah, man.
Yeah.
Body, right? It's just mapped out to map this candle just to show you it's this candle, but you want to use the body. So the open to the close, you want to find the one that has the largest body before a move up in price. Also notice how there are fair value gaps created after it. That shows displacement away from it. Okay. Now in a bearish market, it's literally the same thing, just the opposite. It's going to be an up close candle. Okay. So let's look at some more examples. We have a support level that is taken out, so liquidity was swept, and the market starts to push up and create fair value gaps after the order block. Okay. So taking a look at another example, the market comes into a support level, consolidates a little bit, then it starts displacing, creating fair value gaps. So it's displacing away from the level, and then when the market trades back into that level, we get a reaction. So you can use this as just a level of support or resistance. You can use it to trail a stop loss under it. There's a lot of different uses for an order block, especially once you understand market maker models. Because once you understand market maker models, everything is unlocked in trading. And you understand which way the market's flowing, you understand where exactly to put your stop, you understand how to trail your stop, and we're going to get into that here in a little bit. I don't want to get too far ahead of myself. So we'll look at some more examples right here. We have the market trading up into this high, and then displacing to the downside, trading back up into it, and then moving away. And we have more examples right here. Now remember, if you want to download this board so you have all of it and come back to it later, the link is down in the description. All right, so now let's talk about a fascinating concept that I came up with after watching tens of thousands of candles print over the last 8 years that I've been trading. So this is what I call a manipulation block, all right? A manipulation block is just the same as an order block, except it closes beyond liquidity. Very, very important, okay? Now, it's even higher probability if the very next candle engulfs it. Now, what is it engulfing? When this candle's body engulfs this candle's body, okay? Very, very, very powerful concept, okay? So, this is going to be one of the most powerful things you will ever learn from me or ever learn as a trader, period. But it's the same thing as an order block, but it has to close beyond the liquidity. Okay? Because an order block does not necessarily have to close. It could just sweep liquidity and pop back up and just leave a wick right there. Here are some examples. You can use this for your study. Notice how the market closes below a low, pushes back up, and then moves to the upside. Now you can even draw standard deviations on this, and you'll get this measured move of this candle, right? This exact move, usually 4 times after one is created. Now, of course, you want to pair this with your overall bias. So, for example, On a higher time frame, this whole leg down was an impulse, right? We have an impulse, market was trading lower. So you're visualizing on a lower time frame and you're using it in context, right? Now notice right here, the market closed above this area right here and then extended that candle, not this one right here. Very important. Not this candle, but the one that closed beyond liquidity. Now notice, anybody who was just trading this candle looking for an order block was sad and left behind. But if you map out the one that closes beyond the high, right, you can see that the candle was traded back into and there was a trade opportunity. You'll notice this happens over and over again, right? There's another one right here. It gets traded into. Happens over and over and over again. Once you see this, you'll never unsee it. All right, so now let's go ahead and talk about breaker blocks. These are some of my favorite tools to use, especially if you're trading futures and looking to trade rates on liquidity and reversals in the New York session. We're going to talk about what they are, why we use them, and how to properly map and use a breaker block. So what are breaker blocks? Well, they're going to be powerful levels in price that occur before rates on liquidity. So going back up to these examples we talked about, whenever there's a manipulation, right, there's almost always a breaker. Okay, we're going to talk about how to spot them, but just remember this key concept. So why are they important? Well, they're going to occur at key times of the day when we're expecting liquidity sweeps, which is very powerful because it allows us to refine when we're looking for them. You only want to be looking for these during the volatile times in the day, which we're going to get to later in the time section. Now, they are especially powerful when they're linked with fair value gaps. This is actually called a unicorn, which ICT himself said was the most powerful algorithmic, I can't remember what the hell he actually said. He said it was very powerful, most powerful tool. I'm not into all the algorithmic, all that shit. I just been here to make money. A lot of it's jargon and nonsense. Anyways, so breaker block, which is often mistaken for an order block if you're on the wrong side of the market, is going to form before a sweep on liquidity. So notice, let's just look at just that over there. You would probably want to look at this as an order block, right? But it comes from not understanding the overall bias because in this market, let's just say you were bullish and your impulse was right here. You're not going to be looking for a bearish order block. You're going to be looking for bullish price action. So as soon as the market had engulfed this candle, right? As soon as that happened, you're looking for longs and looking for higher prices. Vice versa in a bearish market. Let's just say the impulse was bearish. You're going to be expecting this to fail. You wouldn't expect the market to come back into and trade higher because you're bearish. Okay. So once it does fail, think of it as like a failed order block. Once it does, you can look for the market to use that as a level to propel it further. Let's take a look at some bullish and bearish examples. So right here we have an up close candle before a run on stops that is quickly engulfed. So that level later on can be treated as a level we're going to likely trade away from. Now notice that it was also paired with a fair value gap. That makes a unicorn pattern, which is extremely powerful. Now right here we have a breaker block that occurred before a sweep of lows. So that's going to be a bullish breaker block. You extend that out in time. And after it was engulfed, now pay attention. This did not activate because the candle wasn't engulfed. The candle did not get engulfed until this candle right here. And if you notice, the very next two times it traded into it after that, it yielded a bullish reaction. Very, very important that you're using engulfing. Okay, I cannot stress that enough. Another thing is you want this to be the last up close candle before a run on stops. Or if it was a bearish example, it would be the last down close candle before a run on stops. Now this is a manipulation. So another way to determine whether or not there was a run on stops is going back all the way to the first thing we talked about, which is manipulation and displacement. Look, manipulation and displacement can be used in everything you do. I said that at the beginning of this course. I will continue to say it, and I want you to always remember that. Just like right here, we have manipulation and then what? Displacement. So manipulation plus displacement, you can look for breakers, you can look for fair value gaps, and you can look for any other things that you're looking for in price. But it has to be in context, okay? That's the most important thing I want to teach you guys. So the unicorn model, which is what we talked about the fair value gap, you want to just make sure that we have our sweep on liquidity, aka manipulation. Then you need a displacement creating a fair value gap, okay? So notice how we have a fair value gap. This zone right here is now a unicorn zone. It's two levels paired together. Now, why is this so important? Well, a lot of people, I think, miss the value of unicorn models.
Yo, so you said the breaker is just a failed order block, yeah?
Yeah.
It just doesn't hold and gets basically inverted.
Yeah. So it just blow through and just come back on the next side.
Right. Now you just wait for it to pull back in here. You're looking for a short.
Yeah, we just wait for it to pull back.
They understand that they're powerful and you can trade from them, yes. But the reason they're powerful is it's just you're combining multiple confluences in one. Now, a lot of ICT traders don't understand the power of just getting probability simply by how many confluences do you have. How many things do you have telling you the same thing, right? All right, now we're going to talk about one of the most overlooked and misunderstood parts of ICT, and also one of the most fascinating, which is time. Okay, time is going to do unlimited things for your trading in terms of refining the amount of trades you're going to take, in terms of looking for what liquidity is to be swept, in terms of looking for what kind of behavior to expect in a price session or in a day, and also to understand the overall cycle that the market is always going in. Okay, we're going to piece together a lot of concepts here. We're going to talk about the power of three. We're going to talk about what time-based liquidity is and everything in between. So Simply put, time and price just refers to the analysis that traders can do using time. Now, why is this important? Well, again, we're going to be able to figure out when we're looking for certain behaviors in price, which levels to trade from, and when to expect expansion versus consolidation. Pay very close attention because this is extremely important, and we're going to be using this heavily in our putting it all together section, which is going to be the trading plan. So first, you must understand the power of three. The power of three is what refers to candle formation. Okay, every candle, we need to understand that every candle has a wick. Every candle has a body, every candle has a wick. Let's just say if you're trying to get in on this weekly candle, you're just trying to catch the weekly expansion. Your goal is to get in on this wick. Now, what if I were to tell you that this wick is not only likely to happen, but it's likely to happen at a certain time of the week? And you're going to be able to use time to identify which reversals are high probability in terms of being the low or the high of the week. Now, you can do this with the daily candle, you can do this with a 1 hour candle, because price is fractal and so is time. Okay, everything you're doing should revolve around time. So we're looking for accumulation at opening prices, and we're looking for manipulation on a lower time frame than the one you're viewing the candle on to form that manipulation versus displacement at a certain time of day, and then you're going to be able to trade the distribution. Okay. Now, opening price is also very important because if the market is forming a wick, it's going to have to move beyond the opening price. So paying attention to the opening price is going to tell you everything you need to know. You can kind of use it as a barometer. If the market's bearish, it should sell off from above it. Okay, and if it doesn't, then you might be wrong on your bias. So again, you can download this whole board. I'm not going to read every word of this and this whole ebook, but essentially, the market is going to move from accumulation to manipulation to distribution. Okay, so distribution and manipulation is what you want to trade. You want to stay away from accumulation. You want to use the range that's formed here in order to trade, but you don't want to be trading this because if we're going to be in accumulation, right? If the market is ranging, we're likely to move out of that before getting the true move. So the manipulation would be this move up, and the distribution would be this move down. That's oftentimes going to happen into a higher time frame level, and it's going to happen beyond the opening price. Manipulation is what you want to trade. You want to stay away from accumulation. Manipulation, right? If the market manipulation is what you're about before getting.
And you see what they're saying about still above the highs. Yeah, that's the manipulation.
The manipulation would be this move up, and the distribution would be this move down.
So if
That's
it's going
oftentimes going to
down for
happen
the
into
day,
a higher
that's what
time
we
frame
need to
level,
be looking to do.
and it's going to happen beyond the opening price. Okay, the accumulation phase, the candle is going to look like this. Now, I want to remember that every bullish candle once was bearish if it has a wick. Okay, it once looked like this, right? So this is a manipulation phase. Now, if you're bullish in the market for this time period, whether it's a day or a week, if you're a day trader and let's say the daily candle looks like this, you should be looking for a buy because that bottom wick is very likely to be created. Okay, and you don't have to necessarily catch the entire expansion or the entire range of the candle, but you can place a good bet if you see your entry model, if you see multiple confluences telling you to buy, and there's no wick created, then you're likely able to get an opportunity. Okay, that is oftentimes
That's what I must say,
a
sir.
time frame level like a fair value gap.
Yeah, what?
I said, if you understand what I must say, sir.
So it's basically they're always gonna make a range, and then they're gonna manipulate the range for the fake out.
Yeah.
And after the fake out, that's gonna be the real move for the day.
Yeah. So if you understand candlestick anatomy, it's every candlestick have
Got a
an
wick.
open, you have a low, you have a high, and it have a close.
Yeah.
So think about it in a bullish market. If you pull up a chart right now, if you pull up Nasdaq or whatever, daily chart. So even think about Friday or the one them push down price.
Right. To make that long wick.
Yeah. All of that I did manipulation. You never have to take yourself, and if you realize the wick we push down, it go into a level.
Yeah.
So it go into a fair value gap or an order block where you could have take an entry from.
Yeah.
And then buy. And the
so,
same thing happen with a sell.
So we want to see it basically gonna make that fake move at a level.
Yeah.
And these levels are from the daily, weekly,
monthly,
the previous high and low, or fair value gap.
Yeah.
Then we gotta map this out every day then.
Yeah, the current candle I will show you. So if you look on the daily chart, the current candle always push down in a level before it push up. So the thing about it is you're there in a bullish trend, the market will go up. All you have to do, wait for the market to pull back and then buy.
Yeah. Hold on a second.
And if it a sell, if the market confirms again, I want bearish trend, all you have to do is wait for the market to push up and then you sell.
Right. All right.
So that is how you really get the buy low, sell high.
Right. I see. So
if just pull up any chart, yeah.
Yeah, this is perfect because this is what I'll be trading. That's what I was gonna show you. I think I had this weekly fair value gap on here. You see what I'm saying? So when I go to the weekly chart, this is what I was looking at. This is the S&P.
Yeah.
And this thing literally hit the 50%.
Yeah. You have to draw it more refined. You have to use the week, just use the week of the candle.
The wick of this candle.
The next, right, that's it then. Yeah.
So it just came in real quick.
Yeah.
You use the wick of this candle.
Yeah, the week of that one. Yeah.
Maybe I'm drawing it backwards too. So from here.
That's why him saying I always come to the 50%. That's why I'm gonna tell you what they say. Sometimes you can set an entry on the open and one on the 50%.
Yeah, so
whichever one of them get tagged.
Yeah, we gotta get in here.
Yeah.
And then look to get in here again, or if it once we start seeing it get turned back here.
Yeah.
Okay.
But I know all of the time it come down, like no matter which time frame, but always come to the 50%. So I always get in on the open.
Yeah. And this is nice, bro.
If it really wide, let's say if it's really wide, then we go wait on the 50%.
Yeah. I feel like, bro,
like if it's a big gap.
If once we seen this gap, we could have started looking for the long from 242.
Exactly.
See.
So if you look on the lower time frame now, we might tell us if you look on go down on like all the 5 minutes.
Alright, hold on. Yo, this is an order block right here?
Yeah, the red triangle. Yeah, man.
So this will be green. This little spot right here.
After a while, you know if you refine them things. When you see those trading view hard, that's why I have them template there. So I set everything. So when I analyze, I can just mark up and just save. I'll show you mine.
Yeah. So just right here, we would basically be we would be waiting for this.
Yeah, that is so alright. So that is the reason why I know my thing.
3 different things I show you say that go.
My chart, that's I always have the daily and the 4 hour and the higher time frame they must show because me want to see when the price of push come down in it. So that's why that is the reason why entire here it's a daily time frame trade signal. It reach a daily order block or favor like that. Entire here it's the H4, it always a touch a H4 favor gap or order block.
Yeah, and then there's another gap in here.
That one there basically gets filled already. So that the previous candle fill it. The green eye, so the green candle in the last push up, the one they fill it.
Right.
No, not that one. The next one, over one. Yeah, that fill the one there.
Yo, it's crazy to me. But do you see this? All the time already. I never, like I said, it's just the other day I started seeing this. Okay,
but I just the timing and when it happened Friday, else would have catch the move there.
Yeah.
Because I remember say we did already after the session and everything. Yeah. Because them really push it up in the last hour. That's why when when you're bridging there, look at trading at the evening, say, yo, don't can't sell it then so it's too late.
Yeah. Yeah,
Because
he was
when
ready.
when when him did that take the trade, it never reached down to that level there. But me did expect it to just continue bleed down. But me never did expect a power move there in the last
Yeah,
power at the Kanga.
that was crazy. But even right here
All,
though at 229, bro.
yeah.
Telling you, that could have been a 20-point stop.
But you can refine it some more, man, and go down on the 1 hour
Look,
time
there's another
frame.
order block right here on the 4 hour.
Yeah, exactly.
Okay, so now go to the 1 hour. You see this low right here, we just basically did the sweep.
Exactly. Sweet low. Yeah.
And we already know the 4 hour got the freaking order block there. So once it hits this line, we know it literally just did the fail. You remember the fail breakout I was showing you? That's how I would
Yeah,
read this.
yeah,
Without before knowing all this, I would just say, all right, this is a failed breakout. We're gonna go back here and go to the top.
yeah. So all you have to do, just expect a reaction.
Yeah. So now, are we gonna look for this to get filled today, or you think?
You know what I say? I just have it mark out, but must get filled today. I just always have them mark out. So just in case it come back, I have it. I wait for it. But you can change the box there to make it have a 50% line in the middle.
How would do that?
In the settings. The
Middle
middle
line.
line. Yeah,
Huh.
yeah.
Yeah, I gotta get my stuff right. As you see, I don't really use trading because I got the Ninja Trader.
Yeah.
But I want to start drawing up on trading view. But I gotta make sure I get the data on here too. Then.
Yeah, man, you have to get the live data.
So now, 15 minutes.
But if you go down now, you can look on the timing. Look on the timing and when it actually react. So look as in look on the clock at what time in the day it happen. As I may say, I think the reversal is starting at the lunch hour.
Why did it say 12:15? That's not 12:15.
12:15 Jamaica time or 12:15 to them time.
U.S. time. It said it started 12:15 U.S. time. Let's see.
Yeah, so the reversal take place in a them time there, right in the lunch hour there.
Yeah,
You have a
12:15. Yep.
you have an indicator we can mark out them session time in between. But
So, bro,
you can,
Friday must have been what we call AMDX.
yeah, AMD, yeah.
Yeah, and you see, so there's 4 letters. There's 4 letters, yo. It's always, and if I show you my, yo, this is crazy to me. Man. Okay. All right, so let me show you this chart real quick. Let me pull this over. You can see this?
Yeah, man.
So A, M, D, right after 12, you should be expecting reversal. X.
Yeah, yeah,
So let me show
yeah,
you how, with what I already know, how I'm going to start adding this, because you see I drew this up. So you see this trend line right here?
mm-hmm.
People say trend line don't work, whatever. Everybody say everything don't work, right?
Yeah,
I've seen what works and what to me don't work, right? So I add it up. When this trend
yeah,
line breaks the back right here, that's what you call an overshoot or a brick. That
yeah,
right there
yeah,
is telling me that we're gonna get a strong bullish push or reversal. Now,
yeah.
if I know that after 12, right here, I'm supposed to get either continuation or reversal. Then I'm about to hit the order block on the hourly, on the 4 hour. You see what I'm saying? How you start adding all that up?
Yeah, man.
But I don't know that before. Now it's like I gotta start adding this up in real time. Cause bro, from right here, I'm telling you, you already see I got this mark from right here. This is telling me it's supposed to reverse.
Yeah.
If I'm truly trusting the overall day cycle as well, it's supposed to reverse. Or it
Because
has a
that's why
potential.
I can split up my trading. So now I look for it and I say, how may I look for? The high time frame target objective.
Yeah.
And then now I look for my entry. The entry pattern of the break and retest are the inversion of the order block from the 5 minute or the 2 minute or 1 minute.
Yeah. Like this, when I'm
So
looking
once it
at this is crazy, bro.
once as it come in at the order block, so sometimes I not even wait for the confirmation. I just jump in and buy.
So this one right here.
Yeah, man.
What would you use as the order block? This one?
Yeah, you can try all the way across. Yeah, yeah, man. But I think on my chart, so my data a little bit different.
Yeah.
Is a fair value gap there.
Yeah, and this is the ES.
Oh, yeah, that's right. Nice to me that look like.
Oh, so now hold on, bro. Is this what you call the breaker, or am I confusing this now?
Yeah, man, breaker. So that is a
Because
bullish breaker now.
at first it was supposed to be an order block to the downside,
To sell, yeah. So you're supposed to come the reject and drop, go further.
but then it
But
breaks out of it right
through it,
here.
it
So
become
then
a
you just
bullish
be
breaker.
waiting for this retest right here to go up.
Ah.
Let's see.
So think about it. If you're not getting a retest, then you're not getting an entry. So that's your entry there. So
Yeah.
right as a retest and it a push up, if you look on the tick chart, you just jump in and set
Boom.
your stop
Yeah.
below the wick.
I would enter here as soon as this bar closed at 211, put my stop
Set
at
the stop.
209.25,
Yeah,
and
exactly.
then just wait for it to keep, hit my target.
So that's why I say right go up there so you can partial out if you want pull back, you pull back and then you do whatever you want.
Because you got another fair value gap right here, and then
Exactly, and you pull back and fill it.
it's literally basically doing the same thing right here when I start looking at it. Because this is the high now. It break this high, come back and retest this little, I guess this one right here, no? What would you call this red bar? Is that another order block?
Yeah, you could have said it's a harder block, but you have a fair value gap in the same area, so I'm gonna really use that.
Yeah, just
so the green
this little
candle,
fair value gap right here.
Yeah, just use the green candle as a fair value.
Because even this last, they basically still come back in here and test this last bearish candle though.
Yeah.
So that's what I'll be looking at. Like this is crazy when you start adding up. I need to mark this area out so I can look back at it on all the time frame.
They just want confluence.
Yeah, there's a lot of confluences for me here, bro. Because even if I don't, one right here, I got my trend line. So even if I should take this trade right here, but even if I don't take this trade, when I get this break in my trend line, I'm still waiting for it to come back and take out that high right there. So this one could definitely be a trade. Even if like this looks like a cherry pick trade, which it's not, because you got all this stuff there.
Yeah.
Yeah, bro, that's crazy. Just gotta be patient. So we just gotta be patient.
Yeah, man, you just have to be patient and wait. So instead of that, me need to work on, because sometimes they are jumping at some trade. And if me just wait for, you only need one setup for the day. And that would be a home run.
Yeah, bro. So, bro, let's do it. That's what we gotta do. We can take our quick scalp. You know, it's a scalp. You don't know if it's gonna run, but we need to be thinking bigger picture like that. I would say.
Yeah. But it come with time still. I just trust because sometimes me did a wait and me did a whole day and I say, come like me now get no set up. And I say, one day if it go really pull back to this level here.
But yo, some
And
days
then
it's like
you
that.
you just jump in prematurely because me I say, you know, look like it go come back here. So and you jump in so, and then you end up force the chain. Then he come back and slap you. That's that happen.
Yeah. But I feel like, bro, that's how it is. Some days I get no setup with the strategy I trade right now.
Yeah.
But now when I'm adding these strategies, it's like some's working some days and some days the other one's not working.
Mm-hmm.
So slowly but surely, I'm gonna show you the way I trade too. And
Yeah.
bro, you gotta understand it's strictly price action. And I don't know any of this until the other day. None of this, bro. And I'm still finding, I guess, putting it together the way I know, and it's still working. You know what I'm saying?
Yeah, man.
So now this is gonna be just more clarity for the eyes.
Okay. Distribution phase is when the market has been in their position and we have a rapid expansion. In distribution, you're just going to be looking to trade into fair value gaps and catch continuations. Okay. So a very key concept to learn. Accumulation, you're going to have a range forming. Manipulation, you're looking to trade liquidity. You're looking to trade manipulation. Right? But once we displace out of that and we're in distribution, you shouldn't expect the market to come back under lows. You should expect the market to just trade from internal to external. This is a concept that a lot of people mess up and they get left behind watching the market do exactly what they want to do, but they don't catch it because they're waiting for something to run on liquidity because they don't understand time. So again, in the manipulation phase, you're looking to buy liquidity rates or sell them if you're bearish, but you're looking to trade liquidity rates. Once the market distributes, yes, you can trade lower time frame rates, but essentially you're expecting the market to stay within its impulse. Now notice how it's so important to pay attention to the impulse because you have all of this noise that can get manipulated and you still move up because you're trading in context of this range of price. What happens when the market comes to a discount and you come under a low, like we talked about before, buying under lows, this is where you look for trade evidence. Okay? And you understand the market is likely to continue because it's in distribution. And we're going to talk about when distribution is and all that in a second, but it's important that you understand the concept before you get into it. Now, the bearish example, we're not going to just break down the same thing again because it is the same thing. All right? So let's talk about the actual framework and execution of this. So step one is you want to determine the overall trend. You want to have your bias. And we're going to talk more about daily bias, but I've already taught you a lot of what goes into daily bias, which is manipulation of displacement and internal and external range liquidity. Okay? So if the trend is bullish, you're using this manipulation to anticipate lower prices. You don't find your bias based on this. You're going to find your bias based on the higher time frames and use this as a complement. So let's just say you come into the market right here. When you start sweeping out under lows, you're looking for a displacement up to then trade up higher, okay? Because you're expecting the market to accumulate and then manipulate to the downside. Because if you're bullish, you're expecting manipulation to the downside. Now you can simply just trade from, like let's say if you're a lower time frame trader and you're trading manipulation, you can just trade to the bottom of the accumulation range. You don't even have to catch that whole distribution. In fact, most of the times you can just trade this, okay? Now, whenever you're using this to trade, you need to understand that it's just kind of a guideline. You don't have to catch the whole entire move. It's just telling you which way the river is flowing, so to speak. Now, once the market is moving down in distribution, you're going to make sure you're only executing trades in alignment with the identified trend, okay? You have to wait until the market is clear. Okay, this is very, very, very powerful if you can master this. And it's not, I won't say it's the easiest thing to master. I won't sit here and tell you that this is so easy and you should understand it immediately. And if you don't understand it, that's fine. Just keep watching this and go test it on price. Right? Test it out. This is what I use live trading with my group every single day. And this is going to unlock the next level, so to speak, of trade. We'll look at some more examples. Let's just say if you're bullish on this day. Well, any sweep under time-based liquidity, which we're going to talk about in a second, but is a high or low formed during an accumulation phase, any sweep lower, you're going to be looking for the market to do what? Market to give you a confirmation. So what do we have here? We have an inverted fair value gap. Not only that, we have a displacement, right? Look right there, we have a fair value gap. So you have two things telling you could have taken a trade right there and looked to target the top side of this range. Or let's imagine the market was bullish and had an impulse in the higher time frame. You can use all of this to then trade up higher into that level, right? You use a higher time frame, you can extend your target. Now, notice the opening price. Okay, when the opening price occurs and the market moves away from it and moves against it, let's just say if you're bullish, the market is moving bearishly away from opening price or below it, trading into a higher time frame level, right? There's a fair value gap here, and taking out the accumulation lows. All you need is a confirmation. All you need is some kind of displacement up, some kind of inverted fair value gap, or SMT divergence, which we're going to talk about in a second, in order to confirm that the market is likely to move higher, and you have a trade set up in and of itself. Now notice again, there's an old high, so there's context here. Okay, market was trading from internal to external range liquidity. Everything ties together if you do this correctly. So very important is knowing when to trade. Okay, so you're going to look for trade opportunities simply during manipulation and distribution, nothing else. You're not going to even look to trade during accumulation phases. Okay, and we're going to talk about in a second what accumulation phases are, when they are, on a daily and a session-based level. Because this concept can be used on a weekly candle, can be used on a daily candle, it can even be used on a session, because every one of those has the smart trading life cycle of the power of 3. All right, so let's break this down into when these time cycles are. So we're talking about on a weekly candle, okay, a weekly time cycle. So we'll say week, day. We're not going to break it down all the way into sessions because you're just going to use the same concept I'm going to teach you right now. So on Monday at 1800, now all of these times are New York time, New York Standard Time, Eastern Time. I get a lot of comments when I talk about time. What time zone? I'm going to make it very clear. New York. Okay, so at 1800 means 6 p.m. on Monday. That is the weekly open. I'm going to add the open over here really quick. So we'll say midnight. Open. Sorry about that. No, the true week open is going to be 1800 on Monday, 6 p.m. So if you want to see sharp moves away from this during the manipulation or distribution. Now, notice how on Monday I say it's usually going to be accumulation, but if the previous Friday expanded, for example, so let's say on Friday the market expanded, okay, we're going to expect consolidation on Monday, and then manipulation on Tuesday, likely distribution on Wednesday, and then possible continuation if we haven't hit our higher time frame target on Thursday, or if we have hit our higher time frame target, let's say it did, we're going to expect a reversal on Thursday. Okay. But the key element to understand here is expansion if Friday accumulated. So you're always going to be, when you're trying to determine whether or not we're doing accumulation, manipulation, distribution, or X is going to be continuation or reversal, what you're going to be doing is trying to determine based on the previous cycle in time. So let's just say on Fridays that the market accumulated. You're coming into the market on Monday. Usually if it's accumulating, the market had just traded into some kind of key level. Let's just say on last Friday we traded into a fair value gap on the higher time frame. You're going to expect the market to give a continuation or reversal. So if it traded into a level, you're likely to get a reversal on Monday. Okay. Now let's just say if the market almost traded to a level, didn't get there, just consolidating on Friday. Well, on Monday, you're going to expect a continuation of the move that happened before the consolidation of Friday. Okay. So the previous session or the previous day, that price action can tell you what's likely to happen. If you got a consolidation the previous day, expect expansion. If you got expansion in the previous day or session, expect consolidation. This is why if London range is very, very large and you're trading New York, you want to stay away from New York because you're expecting consolidation. You wait for the PM session, right? So Tuesday, and everything's going to be dependent on how Monday goes. So Tuesday is going to be manipulation so long as Monday consolidated. But if Monday expanded, then Tuesday could be accumulation. Okay. So Wednesday is either going to be manipulation or distribution based on the other two, and Thursday is going to be distribution or continuation or revert.
Yo, you see this?
Yeah, man.
This is the thing
man.
I was telling you about, bro.
Yeah, man. On the weekly profile.
Yeah, but it's not Friday. But I wonder if this week was Friday because we had the short week.
This week we did have sharp week.
Yeah, bro. Remember we didn't have our market on Monday.
Monday I did that day. Well, the market is still open for half hours, for half day still.
Yeah, so I wonder if they literally just did like the AMBX for Friday.
Possible, man.
Yeah, so
but
now,
remember, as we say, is like a whole heap of factors playing like outside of the weekly profile. As we say, it was the end of the month too.
yeah.
And then we want the monthly candle for close all the way back up at the top. So that's why them dry it up. I have a next thing what them call seasonality. And if you ever hear about that too. I'll say now.
Seasonality.
Yeah. Let's see, seasonality. Sorry. But I still ICT stuff them. But them have more like swing trading and thing. But like it good for like it basically give you a bias.
Yeah. Okay.
So basically, I tell us say expect say the price are gonna be up to the whole month. You know this month. So May is normally a bullish month. June is normally a bullish month or a bearish month. So this is what I'm saying now. This is the experience.
Yeah, I can't lie. I want to see if we're gonna wake up on this monthly chart and come down.
June is normally a bearish month. So I just send you the screenshot. That of the experience and this is Nasdaq.
Oh, so this is the potential
This is seasonality chart. So they might tell you how much what normally happen in each month. So
each month.
it not yeah. So currently we there June. So June is normally a down month. So we go to wake up and then drop back down. So we go to test probably the 50% of that week there.
Yeah.
Or if you look on the daily chart, if you look on the daily chart, one fair value gap there up there we can touch and then drop back. Look on the daily chart. A daily, hold on.
Mm.
One fair value gap there right in there with man.
Right here.
No, that one they get filled already. Hold on.
This one right here.
Think one little one supposed to do but oh which chart you look on? ES.
Yes. What are you on? NQ?
That is a look on NQ.
Alright, hold on.
Now what can happen is so we have equal highs up at the top here, so we can go back up to the top here so and grab the equal highs there and then chop.
Okay, so right here on the NQ.
Yeah, one little gap there so we can feel. And one day in between the monthly chart, that them two last bearish candle too.
These two right here.
Yeah,
This is the type of
yeah,
motion I'm looking for too. A little tick up
yeah,
and
man.
back down.
But anything possible still most of it, we can push right through it.
Oh yeah, bro. I already and low key that's what that's what I mainly prepared for at this point. Because that's what's
Yeah.
been happening. We've just been
Come on,
pushing.
because we're as I said, this year is kind of off cycle year because it's an election year. Anytime you have an election year, you always have some you call it, some different kind of price action.
Yeah.
So must respect them thing. I mean, I expect more volatility, but I guess that will come down more in the year.
Later on.
Yeah, man. Later down in the year, man. We go have just prepare. Just brother, just right now, me just want to pass my funded account then and ready before November. Cause trust me, we're gonna have some wild moving at them time though
There you
when
go.
so when Trump start tweet back on them bag and foolishness start you can trade all night time.
Yeah, yeah.
Yeah man.
Yeah, man.
All
I
night time
used
I
I
go
used to
wild.
do that when it was a bullish market, bro. I'll just
Just buy.
yeah, bro. I'll just buy overnight and leave it like an MNQ, you know.
Yeah man.
I bet. But yeah, bro. We have plenty of time, and once we start studying this is where it's gonna be at.
Yeah man.
Reversal based on the previous two, like we just talked about. So you ideally want to be trading Tuesday to Thursday. These are the days that I live trade with all my students. There's a reason for that. It's not just because I like trading those days, it's because I get my best results. So you want to see sharp moves past that 6 p.m. price on Monday during Tuesday through Thursday. Okay, that's going to be the biggest opportunities. So the day is going to be the same exact concept. Nothing is changing except the times you're using. You're expecting accumulation during Asia, and then manipulation during London, distribution during the morning session in New York, and then a continuation reversal here. Now, the only time this changes is if Asia expands, right, and then London consolidates. Then you're looking for a sweep of London liquidity during the New York AM session. And this happens often, okay? So pay attention to how London acts. If London is expanding, usually you have taken out liquidity from the Asia session, or if you didn't take out time-based liquidity, if you didn't take out liquidity, the London session had a push past that midnight open. Right? You don't have to always take liquidity. You can just push past the opening price. That in itself is manipulation. Now, if you move away from that, then in the next session, expect continuation. Just look to trade for value gaps. Now, you want to be focusing on certain parts of these sessions. You don't want to trade the whole time if you're day trading. If you're trading London, focus on 1:30 a.m. to 4:30. If you're trading in New York AM, I'm going to take it even a further step in refinement and just trade 9 a.m. to 10:30. Really 9:30 a.m. You don't need much. Okay, the less you sit in front of the screen, the better results are likely to be. Now, you can break all of these sessions down into fours as well. For example, you can go 6 to 7:30, 7:30 to 9, 9 to 10:30.
Most of them things that we talk about still apply to 4.
Huh?
Most of them think the way I talk about now with the session timing apply to Forex.
Hmm.
So like if you have trade certain pair, like when we used to trade GBP, USD and then pair there. So that's why I said me wake up 2 o'clock to London session.
You don't you don't have to trade too long in the rise enough.
Yeah. But like them part there now, you know, have to like you know really apply to like we just call it just for NQ1 ES we just call it the overnight session. But now say you know have a bigger volatility you know, because if you back test it and look on the chart, anytime 2 o'clock kick in from them chart there, you have a bigger price movement from
Different.
them. Yeah. Anytime 2 o'clock come, anytime 1 o'clock come in the early morning there, you always have a bigger spike. Because remember, all of them index are linked, you know. So just like how we have the Nasdaq US 30 and SPX for US, the American market, remember so you have the European stock market then we come online, you know. So the
Yeah.
reason why 2:30 in the morning and 1:30 important, you know, is because you have the London Stock Exchange and the Euro Stock Exchange, you know, London and the Germany. Them call it the DAX. That are the German 30.
Right.
So them come online and them overnight traders there we affect the market. Just the same.
Hmm. All
So
right.
you have to pay that's why you have to pay attention to some of them things
But
sometimes.
pay attention to the timing.
Yeah.
Yeah, that's what somebody was. I was really watching that today. He was saying people think it's things get to a certain price and then things happen. He's like, no, it's things get to a certain time and
Time, yeah.
then they
As
happen.
the price and thing pre-programming, basically, as I hear about the NASA and whatever, I contract them, you know. So basically, people hold the contract for a certain amount of time to say, we agree at X time date that we're going to sell at this price or we're going to buy at this price. So essentially, the price have to come back at a level, yeah. That's why in a random. The
Right.
price have to meet at this level in a June by XYZ time and make sure say all we get to do with transaction then. You know? So that's why in a random.
Hmm. You see what you're saying.
Yeah.
All right, son. Like I said, bro, I'm gonna be checking in with you now when we done the live every day.
Yeah, man. Yeah, man.
We gotta keep up with this. If I see a two-legged pullback, I'll show you. You see
Yeah.
these gaps, you gotta let me know, cause then I can check out the NQ. I can remember to check out the NQ, cause I need somebody over here to watch this next chart.
Yeah.
Spinning back and forth is crazy sometimes.
Yeah, that is the reason why I need the next screen, man. I need the next screen to I'm actually order one something there already from Amazon. Like at the stand where the mount we can hold two screen.
Yeah.
Need to get one extra $100 and go price man to get a screen. Can get a screen for about 30,000.
How much?
About 30,000 Jamaican.
You can get a nice screen.
Yeah, like 32 like in between 27 or 32 inch. You can get a nice 1080p screen. A price man.
Yeah, bro. I like the screen I had before I was down here that I was on. It was a big curved screen. That shit could hold everything.
Yeah.
Everything on it, bro. So now, kind of shifting around, you know what I'm saying? Because I brought these two Dell screens in my bag.
Yeah.
No joke.
So, so you never have no problem with customs. They never stop you and a question you or make you pay for them or nothing.
Nah, bro, they just I took it out and I just put it in there because it's for my work. If they really look at my thing, it's for my work.
Yeah.
So they didn't give me no problem.
Because if for me carry through in a brother then tax me, you know. Big money too.
For real?
Yeah man.
Nah, that's crazy.
Yeah, but you can continue.
Hey, bro. No, no, bro. They didn't say nothing to me. That's crazy.
Probably true you use your American, you have an American passport or something.
Yeah, man. Yeah, man.
Yeah.
Going to be trading the likely distribution, and that's my favorite time to
Yeah,
trade.
funny.
I'd rather wait until the market has already got the manipulation out of the way and is moving in my direction, and I get higher probability results that way. Now let's talk about time-based liquidity. Time-based liquidity is just going to be at the high or the low made in any of these times. Okay, it'll be Tuesday's high, Monday's high, it's any of these times. Now, to be clear, whenever we're saying the days, it's going to be 1800 to 1800 the next day. Okay, let me write this down. 1800 to 1800 the next day. One day. Okay, very important that we understand that. Very important. Now, the session highs and lows are just going to be the highs and lows made during these times. So let's say if you're coming into the market and you take out either the previous week's high or low, or the previous day's high or low, or the previous session, or the previous quarter of a session, right? If you're taking out any of these, those are high probability areas of reversal. So time-based liquidity, when you're trying to trade reversals, is really all you should pay attention to. If you're trying to trade the overall reversal from accumulation to manipulation, you want to wait until the market moves past the opening price and also trades into the highs of the range. So right here, we have London session, and look at the highs. The high was right here, it was right here. One of these was, both of them were traded into. And that is the time-based liquidity. And you're going to look for, on the lower time frame, your overall entry models there. Now, if you miss that and the market's already shifted down and given you signs of reversal through inverse fair value gaps, then this is going to be distribution. You're just looking to trade retracements. All right, now let's talk about one of the most subjective and difficult parts of ICT.
So it seems like 9:30.
Mm-hmm.
That first move at 9:30 seems like that's manipulation.
Yeah, man. Right when the stock market open.
That's all manipulation. It's very rare that it keeps going.
Mm-hmm.
But I think if we start looking at the sessions in detail, we could see if it's gonna keep going.
Cause that's how me just map out right when 9:30 start, and map out 7 o'clock when the New York market actually open.
Yeah.
Yeah,
So
so
you
I'm
map
map
that
out
out, the open.
yeah, like I have a line from the chart right as it cross over.
Yeah, and you're gonna see if it tries to take out that higher low, what happened.
Yeah, sometimes sometimes it does change direction.
Alright.
So like we are sell, like alright, like we sell right through London session, the overnight session. And as soon as 7 o'clock come, we hit one fair value gap or one order block and we just start buying immediately as soon as 7 o'clock.
So 7 o'clock, you got a mark.
Yeah.
It's not 7:30. It's 7.
7. I send I send one thing in the group with them
Yeah.
time thing there. Look every seat in the
Let me see it.
show the kill zone then.
7 to 10. Oh, so that's forex. So
Yeah.
for indices, you look from 8:30.
8:30 to 11.
Yeah. And
And
then
then
1:30 to 4 o'clock.
yeah.
Once a power hour.
For the last time, I that the candle I that they push up the market the last time, the last hour.
The big candle.
Yeah, that last candle Friday.
It
It
seems like
happened the,
seems
the
like
last hour.
some days that's what you gotta wait for when it's not doing nothing
Yeah,
all day.
exactly.
So that's
So
from
them chop
4
chop the
o'clock.
market for the whole day until the last hour.
Yeah, and that started at 4 o'clock.
Yeah.
So if it's not doing nothing in the day, we look for that 4 o'clock.
Yeah.
All right.
And if you don't understand this, then literally nothing will work because you're going to consistently be trading the wrong side of the market, which is daily bias. What is it? Why do we use it? And how do we use it? We're going to break it down into 4 easy concepts, which we've already talked about one. Then we're going to talk about candle by candle bias, alignment, and reactivity theory, something else that I came up with over my time in the markets. So what is daily bias? Well, to simplify, it's just the current direction you're expecting the current daily candle to close. In simple terms, are we bullish or bearish? Okay. Anyone in ICT love to complicate stuff? I'm not an advocate of that. I like to simplify it. That's simplicity scales and complexity. So the reason it's important, obviously, is when bias is clear, all you have to do is wait for your entry model during the trading session. If you're bullish, right, you're just looking to buy under lows with the lower time frame confirmation. So what this looks like on a lower time frame is going to be market structure shift, or fair value gaps, or any of these other terms we talked about with displacement that you can use to confirm the market's reversing here and going up higher. Now, market maker models are also present in every single move from internal to external range liquidity. Now, we've already talked about internal to external, but we'll lightly revisit it. Remember, the market's always moving from internal to external range liquidity. Using the lower time frames and market maker models and shifts in structure and displacement, everything else we talked about to confirm when that change is happening. Now, with time, you're likely expecting this to happen during that manipulation or distribution phase. Once you have all of these things together, that is going to give you a higher probability reversal to trade up higher. Now, let's talk about candle by candle bias. If one candle sweeps a previous candle and then engulfs it, right? If it engulfs its body, that's a high probability setup that's going to go higher. If it engulfs the body and the wick, that's a very high probability that the market is going to trade much higher. So even a candle by candle, right? Look right here. The market swept this candle out and engulfed it. That is a sign we're likely to trade higher. If you're trading from internal to external liquidity, right? Let's just say the market had been bullish already, right? The market traded into some fair value gap that was created, and you have this accompanied by that. You can anticipate the market is likely to trade higher according to the bias. Okay. Now you could use this along with other concepts for higher probability. You could use it also to define ranges. So, for example, if you draw a range on the candle that engulfed, that is going to be a price range on a lower time frame. If you extend this out and look at a lower time frame than when you're on, that's going to be a whole price range. You can draw a premium and discount tool or a fib tool on that and look for lower time frame fair value gaps or key levels to trade off of in the 0.5 of that range. You can also look for lower time frame market maker models in that range as well. Now, we're going to talk about alignment. Alignment is when you have all of your higher time frames that you're using, and you don't need to use every single one. You should use 2 to 3. But it's when you have these time frames in agreement of what you're looking at. Let's take a look at this example. So this is the one example we've been looking at through the whole video. Now let's break it down on a 4-hour chart. This is actually the same exact piece of price action. So in that move to the IRL, right, all we're looking at is this right here. This is a weekly chart. We're going to drop down to a 4-hour to envision this move out of this. So we're looking at this move right here. Once the market comes into that weekly fair value gap, once we're down here, what we're looking for is some kind of displacement up to confirm that we're moving out of it and towards that external range liquidity. Because remember, the market is moving from internal to external. And you're using a lower time frame to confirm when this move is beginning. So once the market displaced up right here, we created fair value gaps. We also created an order block right here. And then the market came back down to that and pushed up higher. Now, once you have shifted structure, this is also a market maker model. And we're going to talk about that more in depth in a second, but just be aware that as soon as you shift structure.
So you understand what he's showing? He's trying to look on the. So hold on, let's just listen. This is like a higher time frame. This is like I don't know a weekly. It's a weekly chart. A weekly chart. No, he's looking from the weekly, the monthly to the weekly, go down to the lower. 5 minute, 1 minute. Yeah, but first he start getting the idea on the weekly. So the weekly telling him that it should basically go down here and bounce. So now remember.
Like a top-down analysis.
Yeah, top-down analysis. So what he's gonna do now, see this little wick? He's gonna look for that day for this to get created. That's the range, right? And yeah, where they're gonna manipulate to the up or down side. Now think about it. They want to go up. Where they're gonna manipulate? Down, right? And then they're gonna get that distribution, right, Jay?
Yeah, man.
And then watch this. This is basically the candle right here.
What you say?
I'm saying this whole movement you can see is basically the candle.
Yeah, man. One candle, one daily candle that, or one 4-hour candle.
So A, right, M, D, and then on Friday we had X, the opposite way.
Because that can, is it that pattern can be in our weekly candle or it can be in a daily candle.
Yeah,
So it can happen up in the morning, consolidation at the lunchtime, and down in the evening. You understand? Or
yeah.
sometimes even overnight session.
Well,
Cause
repeat that again.
over,
Repeat that again.
it can happen in a daily candle where you have the accumulation during the overnight session, then you have a manipulation right before 9:30, right in the 9:30 open. And then you have the distribution go right up. You
Right.
understand?
Yeah.
Yeah, so you have and the distribution really you want to catch, And that's the most important thing.
Focus on the distribution count.
Yeah, but you just don't want to get caught on the wrong side, which is the manipulation.
Yeah, of course, of course. That's the shitty. That would be terrible.
Yeah.
I see. All right. But that's crazy to me that it's basically this whole movement when you start looking for it. And like I know on the 1 minute what I'm looking for. You know what I'm saying? Like on the 1 minute here, I'd be looking for a fair value gap that they thought to the downside was gonna work. Right here, right? And then I'd want to see them dip below and then instantly just turn back, take out this high, and then make a fair value gap over here, retest and go, right?
Yeah, man. Yeah, man, sir.
And we could mark. See, on my chart, I don't know about yours. I could mark out this area and then it'll just pop up on all my charts.
Oh yeah, that happen on trade. Well, that happen on your platform.
Yeah. So then that's
That
why.
on
So then the thing
that
is, I
on
would just be waiting for this, and then once I see it come in this area, I would know I should start looking for that little setup we were talking about.
yeah. But that not happen on MT5. Like MT5 kinda old, so I don't really
Yeah.
have them features yet. But the reason why I don't really use trading view anymore is because I find that indicator here. And then now sometimes there's a little price difference in between the feed pan trading view and the feed pan my MT5.
Yeah.
So like we are look on Nasdaq and Nasdaq on trading view with the 18,644 and then for my broker it's 18,620 something.
Huh.
Yeah, so I'm not really use the two. I just use one.
Yeah. No. Yeah, I use Ninja Trader and TradeStation. They're pretty close. I
Yeah.
would say.
Time frame to confirm when this move is beginning. So once the market displaced up right here, we created fair value gaps. We also created an order block right here, and then the market came back down to that and pushed up higher. Now, once you have shifted structure, this is also a market maker model. And we're going to talk about that more in depth in a second, but just be aware that as soon as you shift structure, you're now on the buy side of the curve, which means you're seeking out highs. You're pairing this also with your higher time frame. So at that time, any bullish level is being bought. You're not looking to sell at all. You're just looking to buy until that higher time frame target is met. Okay? That is the power of a market maker model. On the right side of a market maker model, you're only looking for one side of price action. You're looking to buy under lows or in fair value gaps, or in order blocks or breaker blocks, or any of the tools that I've taught you in this video. Now, inside of this move right here, look, we can take this another step further. Inside of this move into this fair value gap, we can go to a 15-minute because that is what you use to confirm a 4-hour. And I'm going to give you a whole list of the time frames you use here in a second. But right here, we have the 15-minute. Now, this is the exact same move. This is this bit of price action right there. So remember, the market is already in alignment on the 4-hour and the weekly. So you're just looking to confirm this move into that fair value gap and confirm it by what? You guessed it, displacement. Okay. Once we've created a displacement up, we've created a fair value gap, taken out structure. So at that time, as soon as this candle closes, as soon as we form that fair value gap, the market is bullish, and you can look for bullish levels such as order blocks or breaker blocks, which we have over here, to be respected. At that time, you can do the same thing on a 1 minute and look for entry model to trade higher. Okay. Now this happens over and over and over again. Okay. Until that overall highest time frame target is met, you're going to see lower time frame market maker model inside every single higher time frame level. Okay, that is how you have a clear daily bias. Now, something else you can use is reactivity theory. Now, this is something that I came up with. There's also a link to this video. Basically, it's really just asking yourself in a dynamic way, which side of the market is failing? How are we reacting to fair value gaps? How are we reacting to order blocks? The way that we're reacting to these levels, if we're not displacing away from them, then you're not likely to continue. For example, if we trade to an order block, what do we want to see? we want to see a big push out of it, right? We have a fair value gap coming out of it, so that confirms that level. Anytime we trade into manipulation, if we're trading into lows, we should see fair value gaps come away from it. So it's all about, are we displacing away from one side of the market? Is the market forcefully pushing in one direction? This is a little bit of a discretionary way to reprice, but it can help you a lot if you can get it down. All right, next, we're going to talk about something that I have referenced a couple times in this video, and that is market maker models. We're going to talk about what they are, why we use them, and how to use them. And this is another concept that's super, super overcomplicated, and a lot of people get overwhelmed by it. It's just simply because they don't have a practical way to view them. So we're going to talk about how to use them to plot out every single move from internal to external or vice versa. Because every time that this happens in a higher time frame, a lower time frame market maker model can be used to confirm it. Now, all it is two consolidations leading into a reversal aligning with this. I can't stress enough how the context is the most important part. Because if not, you're just trading patterns and you're not pattern traders. Okay? So market maker model is just a strategy to visualize retracements and expansions on a lower time frame. The reason we use them is they identify what side of the curve you're on and confirm your higher time frame buys. And they help you with trade entries and stop loss placement as well. This is the alignment, or these are the time frame pairings you should use. Okay, if you're using a higher time frame fair value gap or a high or low, you should be using the ones on the left side of this. And to confirm them, you're going to be looking for market maker models on the right side. Okay, forgive me my beautiful drawing there. So we'll say the market moved up into this area, right? And there's a fair value gap on the way up. So we're expecting the market to move from external range of liquidity. We'll say we took out a high over here, created a fair value gap. Above that area, we're expecting a consolidation, and then we're expecting a retracement, right? Just like we talked about in the very, very beginning of the video. This in itself is a market maker model. You just didn't realize it at that time. Maybe you did. Maybe you're more advanced than most people, but most people just see it as the simple, perfect formation, but it's not. It's just a retracement or an expansion. Okay? There's a market maker model here, and there's a market maker model there. So it's going to be two or more consolidations on the way down into an internal to external move, or an external to internal move. Now, I will say trading the ones from internal to external are easier for beginners, so I recommend just sticking with that until you have that mastered. So, on a higher time frame expansion, and you have a fair value gap, you're looking for a lower time frame market maker model confirmed by that market structure shift, which is just a displacement or a change in impulse structure. So if you have impulses down, whenever you get to that impulse and you displace up, creating a fair value gap, at that time, once you cross that line, you are bullish. And all you're looking to do is buy under lows, or buy in fair value gaps. Plus, if you have a combination, notice we have an impulse structure right here. So there's a fair value gap. You bought under lows and a fair value gap. Now, what you can do as well, let's say if you got in down at the bottom of this, let's say you took a trade down here or right here in this fair value gap. Every time the market sweeps out lows, trail your stop. Sweeps out lows, trail your stop. Or if the market puts an SMT divergence, which we're going to talk about in a second. Now, you can also get multiple trade entries. Every time the market comes under, there's going to be an opportunity there on a lower time frame to look for confirmation. Same here. Okay. We already looked at this example. We want creating a fair value.
And yo,
gap.
that's the same thing I was showing you earlier, right?
Every time the market sweeps out lows, trail your.
Even before I knew what the hell this was, I'm buying this. And I'm buying this.
Stop. Sweeps out lows, trail your stop. Or if the market puts an SMT divergence, which we're going to talk about in a second. Now, you can also get multiple trade entries. Every time the market comes under, there's going to be an opportunity there on a lower time frame to look for confirmation. Same here. Okay. We already looked at this example. We won't hang out here too much. This is that 4-hour example we looked at in the last part when we were talking about daily buys. Next, let's talk about SMT divergence. Now, this is one of the most powerful tools you're going to be able to use, not only to have bias, but also to make some time and price, and also to get trade entries and how to trail your stop loss. We're going to talk about what it is, why we use it, and how to use it. Okay? SMT stands for Smart Money Tool. Now, some people say Smart Money Technique. ICT has said it both ways. Anyways, we are using this to identify manipulation. So whenever we're talking about manipulation, right, we have that pop under low, and we don't displace through it, and the market pushes away from it. Now, at sometimes, the market just does this and pushes away. This is also called an SFP for some people, a swing failure pattern. So we fail to push through and make a swing. But oftentimes when this occurs, let's say this occurs on the S&P 500. Well, a lot of times, NASDAQ might be making a lower low. That would be SMT divergence because it's a crack in correlation, and that's all SMT divergence is. It's when there's a crack in correlations, it's basically showing you there's some kind of manipulation, or there's some kind of smart money activity at play. Because when markets that are very large, like the stock market or Forex markets, aren't moving appropriately, that shows that there is a large force at play. So this can be used as a tool to confirm your trades or confirm a bias. So let's look at some examples. Notice right here, NQ had made a lower high, while ES had made a higher high. If it happens at the highs, remember, if it happes at the highs, it's bearish, because if highs are being manipulated, the market's bearish. Okay, so a lot of people will say whichever one makes the lower high, whichever one fails to put in structure is the one you should trade. I disagree with that. I think you should trade whichever one has the highest probability based on the rest of your analysis. I think simply saying you're going to trade one or the other, it just adds into the identity of someone who's a pattern trader who only uses one confluence to trade, and trust me, that's not going to work for very long. That's with indices. So NQ and ES, you can also use this with YM. However, I think that it's higher probability with NQ and ES because it happens all the time with YM. especially if you're trading a 1 minute time frame. Now, the inverse of this is going to be EU or DXY. So EU or DXY, which is Euro USD, now this can go for any currency that ends in USD. Okay, any currency that ends in USD. It can be GBP USD, Aussie USD, NZD USD, any currency that ends in USD. Okay, so the dollar, which is DXY, should move opposing to these. Right, the dollar should move against them. So if the dollar is making higher highs, then EU should be making lower lows. And if it's not, that could be bullish for EU and bearish for the dollar. Okay, very, very important. Now you can also use this with crypto. Bitcoin and Ethereum, think of it like NQ and ES. They should move together, and if they don't, then that can be a sign that there's foul play or manipulation of the market. If it happens at the lows, it's bullish, or if it happens at the highs, it's bearish. If you want to download this entire board all for free, that way you have all of the examples, you have the mind map. Let's go right into it and talk about your bias checklist. Okay, so bias. The first thing you're always going to do is weekly IRL to ERL and weekly candle bias. Okay, now you don't have to have both of these. Okay, I want to be clear. You don't have to have every star aligning in order to have bias. You're just stacking up how many things are telling you bull versus how many things are telling you bear, going from the top down, meaning the higher time frames down. So if you've recently traded into internal range liquidity and you're sweeping out the previous candle's low and engulfing it, that is a very bullish sign. If you come to the market on Sunday and you see this, you should be bullish in that week. And if you're bullish in that week, you'll expect some kind of manipulation down before moving up higher, okay? And you're going to go through the rest of the time frames to determine the roadmap you'll take. Now, another thing that I want you to pay close attention to is the economic calendar, okay? This also goes in tune with time, but you need to look at this when you're doing your weekly analysis. It's extremely important. You should map out your entire week based on this. So you're going to go and you're going to turn off everything except red folder news, because everything else is noise. You're only going to have whatever markets you're trading. You don't want to have everything under the sun on here. It's going to be all over the place. So I only trade futures, so I'm just using USD. So if you see no news on a Monday and we're expecting consolidation for whatever reason, then that is even more confluence that you shouldn't be trading because there's no high impact news. There's a lot of these gurus out here who will say, I don't trade high impact news. Anyone who says that is a fucking rookie, okay? I'm not saying you should trade on high impact news, like at the moment it's happening. Don't be an idiot, okay? I'm not saying that. I am saying that these are the days you will expect volatility. And as a day trader, I don't know about you, but I like when there's volatility, considering that's how I make money, okay? A lot of people say, oh, I don't trade any high impact news, but have fun, never trade it, because there are a lot of those that you should trade these. Don't trade right before them, because your stop loss will likely get slipped and you will likely lose a lot of money, more than you thought. So don't be stupid and try to gamble news. However, use it as a you should expect that there to be volatility in these days.
Huh? I said, learn that the hard way.
Man get rich, man get dark crashes.
Yeah, man.
Expect the manipulation and the distribution to probably occur when there's the most high impact news. So very important that you look at that when you're doing your bias. So the next thing you want to do is move to the daily time frame and see what is the daily time frame telling you. Okay, well, in this example, this is the same exact thing we just looked at. You have that weekly fair value gap. Market swept out the previous day's candle and engulfed. So you have a very bullish bias. Now I know you might be thinking, oh, well, what if the market has different, tells me different things? What if the market's not in alignment? Don't trade, okay? So many people I work with, they just can't get it in their head that there will be times you can't call the market. Now, I cannot stress enough the importance that you understand that the goal here is not to just be able to call the market all the time. I recently had a call with someone. They said, I don't want to really learn how to trade all the way. I just want to learn how I can look at the chart and tell where the market's going to go. And I told him, well, if you figure that out, please let me know. Because that's not what trading even is. Trading is identifying when you have high probability and acting and executing when you do, and being able to identify when you don't, okay? So if you don't have alignment, if you don't have high probability, then don't trade. You're going to be doing the same thing on the daily as you did on the weekly, right? Internal to external, we have a fair value gap. So you're expecting the market to move to highs, and you have that candle bias telling you the market is bullish. So inside of that daily or weekly fair value gap, you're going to want to use market maker models to confirm. So coming into the market, we have that weekly fair value gap. You can look and say, oh, we had a market structure shift. So at this time, I have the daily and the weekly telling you we're bullish, and I have this overall market maker model telling me we're bullish, high probability. So this time, you're just looking for 15-minute market maker models, or going back to the pairings I told you earlier, right? Whatever internal or external you're using the lower time frame to the right of these to look for market maker models to then plot out and navigate the sessions and trade your trades, okay? So after we've done that, you've established we're bullish. We're looking for internal to external on the 15-minute, and also, very, very important, you're looking to reactions. You're looking for reactions to time-based liquidity and the opening price. Now, this is the New York session, so if you go back to the part of the video about time, you'll see that we're looking with 7:30 open, and you're looking for time-based liquidity. Now, look at this example. We had taken out the London low, and we had taken out the 6 to 7:30, which is the first quarter of New York, and you take out Asian session before. So you're expecting the market to likely move to the upside because you're bullish on the higher time frames. You've gotten the London low taken out. You've moved away from the 7:30 opening price and manipulation swing. You've taken out time-based liquidity. At this time, all you're looking for is an entry confirmation. And at that time, you can take the market much higher to the previous day's high or opposing time-based liquidity, such as that or such as the London high. You can also even take profit at opening price if it's far enough away. You only want to do that when you're anticipating consolidation. Okay. So now let's talk about our entry checklist. All you need is 2 or more of these things on your checklist to have occurred in order to have higher probability. Okay. The more you have, the better. So you want to make sure your higher time frames equal your lower time frames. And the example we just used, so what that would mean is our lower time frame is equal to our higher time frame. We're bullish on the daily and the weekly, and we're bullish on this 4 hour. Okay. All the time frames are equal. Okay. Now in this example, we would have wanted this to be bullish if we want our lower time frame to be equal to that. So in this example, you didn't actually have a pure, full-on alignment, but that's why we just need 2 or more of our entry checklist. So you can check for those market maker models in those moves, but you also need to look for manipulation beyond the session open or time-based liquidity sweat. So in that setup, we had this right here. We also had a higher time frame key level, and we had a clear higher time frame bias. Okay, this has to happen in order for you to even look for your entry checklist. Without this, you don't even look here. Okay, very, very important. These don't apply if you don't have a clear bias. If you have 2 or more. Now, the one that is required here is a lower time frame confirmation because you need some kind of shift or something telling you that the market is going to move in your direction on top of these other confluences you have here or here. Okay. I'll put this as a target. Forgive me. Anyways, so what is a lower time frame confirmation? We're going to focus on 3, which is the market.
What? Where do you see LTF? Lower time frame.
The structure shift.
High time frame, lower time frame. High time frame is like 1 hour, 4 hour, or daily, weekly, monthly. Lower time frame like 15, 5, 1.
As a divergence or inverted fair value gap. These are just your tripwire or kind of your cue to pull the trigger. And this is the very last thing you look for. I see so many traders just use this and then wonder why they suck at trading. Anyways, so you want to look for a key level, right? So we have a key level being an old high. That's the first step. Now we already have checked off a couple of the checklists from what we just talked about. So we're going to focus on the actual entry model. So market structure shift is just that. It's a shift in impulse structure. Now notice the market had been making higher highs, and then what happened? We took out a low and created a fair value gap. Once the market trades in that fair value gap, you can look to trade with a stop loss of the first candle in the fair value gap. You can also put your stop loss above here if you like, but oftentimes if you put your stop there, if the market goes there, it's probably going to go here too. So this can help you a lot with your risk to reward. Now, you always want to target at least 2R, but we're going to be able to get much further if we're pairing everything I've taught you in this course together. For example, in the price example that we just talked about, right, this is the exact 15-minute view of this right here, right? I'm sorry, the 1-minute view of this right here. This is the 15-minute chart. Down here, so as soon as we checked off our boxes, as soon as it gets to be 9:30, right here it happens right at 9:30. Don't expect that always to happen, but as soon as you have that market structure shift, that is a trade entry, right? You can look to take a trade right there. And notice we didn't just target 2R, we're able to target opposing time-based liquidity because that higher time frame was bullish. Right? Remember, this goes back to the fact that we had a clear bias in the higher time frame and a clear market maker model right here. Now, this was the high we're targeting in this example. Notice how we're not targeting all the way up here. We're not swinging for the fences because we're day traders. We're just using this to identify what way the river is flowing. We're not using this to trade that entire move, okay? Now, the other entry models are going to be SMT and IFBGs, or inverted fair value gaps. So an SMT can occur before a market structure shift happens. So notice this price leg was very expansive down. It took a little while for us to get that market structure shift, and you could have got a trade entry right here, but with S&T you were able to get it much earlier. Okay, so on Nasdaq you had a lower low, and on ES you didn't. You had a higher low. So as soon as that low is confirmed, you're able to take a trade. Now make sure you wait for the candle to close after the low is in question, because until the next candle closes, you don't really have a low, right? Like this isn't a low until this candle closes with a higher low than it. Okay, so at that time, you're able to execute the trade, and then you target based on the time-based liquidity. That's really where you're always going to pair your trades, is opposing time-based liquidity. Because if the market is bullish, if you're right, it's likely to move past those areas. Because the market, in order to be bullish, if you have a bullish day, usually it's going to take out the previous day's high, or at least the previous session's high. So those are great times.
Yeah, I mean it closes, but how do you know it's a low until it tries to go up, come down, and then go?
Times to take off the trade, and it becomes very objective in terms of targeting. Next, let's talk about the inverted fair value gap. Okay?
When I have on the tick chart, you can see it good, man.
Yeah, bro, the tick chart is so good with that.
Yeah.
excellent signal for entries, and it comes before a market structure shift. So we have a fair value gap right here. As soon as the market closes a candle under it, you're able to execute the trade. And if you notice right here, market structure shift didn't really happen until all the way over here, and you would have had to have your entry down here, which would have almost doubled the size of your stop loss, which then pretty much cuts your profits in half because your risk reward is so much lower. So inverted fair value gaps, SMT, or market structure shift, they can all be used interchangeably. Just like anything else I've taught you, if you have two or more of them, or maybe all three, that is even higher probability. So here's the entry checklist. Again, you can download this whole board. The link's in the description. Has all this here for you. Now let's talk about risk management. So R equals the total drawdown divided by the number of consecutive losses. Okay, so in order to really understand how to determine what an R is for you, I see so many rookie traders. They say just risk a static amount, just risk 1%. I think that's really stupid, to be honest, because for some people, they might be able to risk more, or they might be able to risk less. For example, if you're a high risk reward trader, you probably should risk less because your win rate's probably lower, so the number of consecutive losses is probably higher. So you need to figure out by data, and if you're not tracking your data using something like TradeZella, which I'll have a link down to in the description, if you're not tracking your data and journaling it, you don't really know what you're doing. You don't have a business, and you're just a gambler, okay? So you need to understand what is the likelihood that you're going to have 10 losses in a row. Well, if you have 10 losses in a row, if that's something that can happen to you, you want to take the drawdown that your prop firm has allowed you, or the drawdown that you are willing to incur on your personal account, and you want to divide that by 10 losses, okay? That is your R. That's what you risk per trade. You're going to start with one of those from break even if you're just at 0. Now, if you get to 2R profit, you can risk 2R. Now, I want to be clear that if you're trading on a trailing drawdown prop firm like Apex or Top Step, this I wouldn't do unless you've already got funded and you've built a cushion and the trailing drawdown has stopped. Okay, very important. Now, this I would recommend doing regardless. Now, this is if you're in drawdown, you're going to cut your risk in half. This is going to protect you from going on tilt. It's also going to protect you from losing streaks and losing an account just because of a couple bad trades. Now, on the day, this is part of risk management that a lot of people ignore. You need to stop if you get 2 losses or 1 win on the day. And as long as you have a 2R or better risk to reward, then your losing days can never outweigh your winning days. Another note to have is that trimming is better than break-even stops. Trimming, you will secure some money and eliminate risk, and your risk of getting stopped out is lower. For example, let's say if you're in a trade from right here, and the market, had already been moving, the market could come up and stop you out before reaching your target. Let's say this is your target. Instead of putting stops to break even, right, you could just leave your stop up here. What you should do is just trim half, because you just eliminated half of the loss you'll take if the market actually did move all the way up. And what that allows you is having room for the market to move higher and still go to your target. Okay? Cool little gem for you guys. Now, I just gave you everything that you need in order to become.
Good looks, brother. You're gonna stop it right there, though. But yeah, yo, that was some good stuff.
Yeah, man.
Say less, bro.